We're sort of signaling caution here. We have not added to equities.
We want to be positioned for a rebound.
The U.S. is the best house in a bad equity neighborhood.
The market as a whole probably still has some mean reversion.
We've got a bullish and bearish tug of war going on here.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now, coming into Thursday following a primetime address.
We are on track to complete all of America's military objectives shortly. We are going to hit them extremely hard over the next 2 to 3 weeks. We're going to bring them back to the Stone Ages where they belong. If there is no deal, we are going to hit each and every one of their electric generating plants very hard. When this conflict is over, the Strait will open up naturally. Gas prices will rapidly come back down. Stock prices will rapidly go back up.
The president offering very little news, sticking with a 2 to 3 week timeline, leaving the Strait of Hormuz closed, fueling another move higher in crude and weighing heavily on risk appetite, sending equities lower, stocks trimming a 2-day bounce.
And here we are back in whipsaw land as people take a look and say, OK, it might be now 2 to 3 weeks rather than 1 to 2 weeks, but we're talking about escalate to de-escalate, and that could potentially introduce the damage that people have been worried about to physical infrastructure. Economics, Oxford Economics, Ryan Sweet said something really interesting. He said that the military timeline differs from the economic one. And given how long the Strait is going to be closed for, you can assume $113 on average for the second quarter for Brent crude, and that materially changes estimates.
Brutal. That's a big change in the outlook. We've talked about this repeatedly. This market wants two things: end the hostilities, get energy moving again, and after that address last night, no indication you'll get either anytime soon.
Especially when it comes to the Strait of Hormuz. The president once again said that the United States is not as reliant on it, so it's up to other countries. He said that they should really go in there, muster the courage, and try to open it up. Or he then offered another scenario where if the hostilities end, it will just naturally open up. But the problem is right now, the game is changing for the Iranians, and they want to start charging vessels to come through, and they are going to decide which countries should be allowed through depending on which flag is on the vessel.
The next phase of this is the data. The earnings that come out in the next several weeks, the guidance that comes from corporate America and leaders around the world. This is the data so far, and this is the good news. This is the good news as we approach payrolls Friday. The data so far has been good. 3 for 3 on Wednesday. Retail sales, ADP, ISM, pretty decent across the board.
Yeah, the bad news, the rub, is that prices paid, the component that you people were looking at, rose to the highest level in ISM going back to 2022. Even when you look at sentiment surveys, people are really concerned about the inflationary impacts. This is what's going to affect margins. This is what's going to affect outlook. How do consumers respond to that? Yes, retail sales were strong for February. At what point does this higher cost start to suck up some of the oxygen in the room?
And tanker trackers said to their knowledge, not a single LNG tanker departed via the Strait during March of 2026. To your point, maybe the military conflict is on one time, but the economic conflict is going to be felt for weeks and months to come. And it might be 6 months, potentially, once hostilities end, then we get normal flows back to the Strait.
Brent crude right now up 7%, 108 on Brent this morning. Coming up this hour, we'll catch up with David Stubbs of AlphaCore as a 2-day equity rally stalls. Ed Mills of Raymond James as President Trump vows to continue strikes on Iran. And Stephen Schork of the Schork Group as crude climbs once again. We begin this hour with President Trump offering no clear off-ramp for the war with Iran. Our team coverage starts right now with Bloomberg's Tyler Kendall in Washington. Good morning, Tyler.
Hey, John, good morning. Well, President Trump sought to reassure Americans that the war in Iran is in the national interest as he maintains that the U.S. is nearing completion of its military objectives. Still, he also previewed that the conflict could soon escalate as he renewed threats to hit energy infrastructure. In fact, a person familiar with the matter tells us that Vice President J.D. Vance delivered a very similar message to intermediaries that there will continue to be increased threats on strategic assets until Iran agrees to a deal. This White House is maintaining that diplomacy continues and is ongoing, though at least publicly, Iran has so far denied being in formal negotiations with the U.S. And our own analysts at Bloomberg Economics say they are expecting a short-term escalation before this turns into what they are calling a low-intensity war. It felt clear that President Trump was trying to defend against foreign policy decisions, but also defend against some of those domestic policy impacts as Americans pay more for prices at the pump. And we already knew that affordability was emerging as that key messaging as we head into the midterms. And while the Pentagon has outlined those tactical successes of this mission, including degrading Iran's military capabilities and hitting more than 11,000 targets, we didn't get any new solutions from President Trump when it comes to some of those strategic setbacks. Of course, most notably, the closure of the Strait of Hormuz. John, as you well know, President Trump ramped up the pressure yesterday when it came to urging allies who get their energy supplies from the Strait to take the lead in securing it. But as Annmarie mentioned, he also said that he thinks that it will, quote, open up naturally once this conflict resolves.
Alejandra with the latest in the nation's capital. Tyler, we'll catch up with you again soon. It's been a confusing time through the week so far. On Monday, open the Strait or else. On Tuesday, the Strait is someone else's problem. On Wednesday, a mix of Monday and Tuesday.
And ultimately, what I find fascinating is that markets continue to respond to this. And it seems like they are looking for some signal. Yesterday, the fact that there was a rally on the heels of something that could have been considered a little bit more conclusive with ending the war was just completely turned around today after a speech that didn't give them what they wanted at all. At what point does it lose its punch, right? At what point does true social diplomacy not have the same effect on markets?
Equity futures this morning negative by 1% on the S&P. Here's the view on Wall Street this morning. David Stubbs of AlphaCore writing equities end the year higher, but with significant volatility if the war drags on. The US is a net energy exporter. There are also positive aspects to higher prices. David joins us now for more. David, good morning.
Good morning, buddy.
Tell us about those positive aspects of higher prices, please.
Well, the US is a net energy exporter. If you get elevated prices for a period of time, then the energy complex in the United States will respond to that. In general, the US is fairly insulated from the consequences of its own actions here, right? Their energy is less than 3% of the CPI basket. There's also tremendous tailwinds that we came into the year talking about, right? You have a lot of fiscal support from the Biden bills and the Trump bill last year. You have the ongoing AI build-out. You have tremendous strength across the balance sheets of consumers and businesses in the US. So I'm not saying that if you have this kind of nightmare scenario where this plays out for months on end, that everything's going to be fine in the United States. But relatively speaking, the US is more insulated than any other major economy.
Looking at the S&P 500, we know what the weightings are from sector to sector. What does it mean for the earnings profile of the S&P and the companies and the exposure that they've got, not just to the US story, but the international one as well?
Well, I think the point you just made about earnings season, this is going to be a great excuse to throw in any kind of issue, right? And a great excuse to not give any guidance and throw up a lot of uncertainty, maybe add a dash of job cuts along with AI. We know that the CEOs will take that excuse. But I think at the moment, what's been illustrative is the earnings profile has remained very strong. There's different ways to think about that. But if you do a dividend discount model, for example, we started the year assuming something like 15% earnings growth. Today, it's only about 13%. That's well above the 9% we saw in the 2010s, and well below the bubble territory of low 20s that we saw in the late 1990s. So I think the market is priced for a continuation of this huge AI build out, and that ultimately is where the rubber meets the road, right? We've all heard a lot the last few days about helium, that being an important a part of semiconductor production, and that's when it really gets real for the US economy and I think other economies around the world. When does this disrupt that huge pillar of growth and earnings which we've seen from AI in the last couple of years?
The production of semiconductors in particular, which helium is a key ingredient for, on a broader level, at what point does the disruption to supply chains disrupt the AI trade and the AI build out more materially? Just if you zoom out, I mean, how do you gauge that?
I think you gauge it from a drawdown in the inventories that matter for semiconductors. Most of the producers, to your point, have 2 to 3 months of helium inventories. Those are starting to draw down. I think obviously if you were to see a much higher energy complex here in the US, you'd start to see some rethink of these energy-intensive data centers, for example. But at the moment, even with 4 or 5 weeks into this, that we haven't really seen that impact on that particular complex. Now, we've seen dramatic impacts around the world. Look at Asia. Look at the rationing we're seeing in some economies there. Look at the stimulus that some of the European nations are putting in. Look at the potential for this to morph from terms of trade shock into a balance of payments issue. So there's very severe issues around the world, but at the moment the AI complex seems to be untouched.
It seems like the fiscal impulse is going to leave equities in a decent position. Maybe not just globally, but certainly in the United States. Everyone keeps talking about how they're going to keep pouring money on this because that's what politicians do, especially of late. How much does this come at the consequence of bonds? How much does this end up leading to a steepening yield curve and a real penalization of people who are trying to find safety in fixed income.
Oh, absolutely. And this is the new world we've been in, the regime change of fixed income and equities, fixed income not hedging, equity drawdowns. And we've gone into this, of course, in a fragile position, because you had years of above target inflation, because central banks believe rightly that in some cases that their credibility is somewhat thin in that regard. That's what really could make this, again, go from bad from worse. So if we see a tipping point where certain central banks feel they have to act to defend their credibility, even though they're taking a hit to growth, but that'll probably be the ECB that does that. If we get to that type of position, that's one of the ways that this gets a little non-linear. It's a way that this becomes more of an annoyance or more of a difficulty.
If they hike rates.
If they have to hike rates. If they're kind of bullied into that by market pricing. If you see inflation expectations become unanchored. And it's crucial to point out, in the US, you've seen the opposite. 5-year and 5-year forward break-evens are down by 10 basis points since the war started. But in Europe, they're up 5 basis points. Small beer, sure, but that's the direction of travel. And again, the ECB has history here. If you go back, if you remember your history, 2011, Jean-Claude Trichet hikes twice into an energy price spike, and in 2008 as well. This is, I hope they've learned the lessons and they don't do it.
We've heard from the Europeans just moments ago, the French president, in comments to reporters. The headlines read as follows. It's unrealistic to free the Strait of Hormuz by military means. The Hormuz Strait can only reopen in consultation with Iran. Those comments just dropped in moments ago.
So basically having the cooperation of the Iranian regime, which the United States right now is obviously striking and trying to decimate, to the president's words yesterday. This feels very different than what the president wants to see, which is the help of the Europeans sending things like minesweepers or part of their navy to the Middle East to help them reopen it. Rutte is supposed to be in Washington, D.C. next week, according to reports, and I imagine a lot of this is going to be brought up and potentially becomes a bit more of a fractured discussion between European allies and the United States.
The rest of the world is in a really uncomfortable place right now. I'm sure you've been tracking the headlines worldwide. We've seen a series of governments in Asia shifting to a 4-day work week. We've seen fuel rationing in places like Indonesia, in Sri Lanka. This from the Australian Prime Minister to start the week as well. Over the coming weeks, if you can switch to catching the train or the bus or tram to work, do so. On the surface of things, you might shake that off. But I wonder what the next phase of that kind of address from a Prime Minister is going to be. Is it going to be if you can or you must?
Well, that's what people are expecting, that there's going to be supply rationing come at least as soon as this summer in places like Europe, if there isn't some resolution to this, because they are working through their stockpiles. And that last shipment of jet fuel, I keep thinking about that from our conversation earlier, is slated to arrive. And there is nothing after that heading to the European region.
David, there is a deeply uncomfortable COVID-type feel to some of these dynamics. How do you see it playing out in the next few weeks? Not in the US, but elsewhere.
I think it's going to be pretty rough internationally because, as you said, it takes 4 to 6 weeks for some of these ships to get there. They left it before this hit. We only got a couple of weeks of that. Then we obviously have 4 to 6 weeks of most inventory. So we're writing in our Q2 commentary that if this is not solved in the second quarter, the second half of the year is going to see COVID-esque impacts to the most vulnerable economies. Who are they? If you're energy intensive, energy dependent, and also you have some limited fiscal space and limited space to absorb a trade shock, those countries are going to be severely affected.
Is this a reason why you're not necessarily as excited about, say, going into South Korea right now, or even, dare I say, going into European assets, given that there's been a drawdown and some people are saying, well, this is a favored trade before this shock and it will be afterwards? You disagree?
I think if you could magic away the shock, I think that we would come back to the same kind of principles. But as you said, even if you shut it down tomorrow, there's a delay with the ships, there's a delay with the refinement, and then on what planet do we not have a sustained risk premium in products from this region, even if the Iranians play ball? Right? Because the vulnerabilities have just been made so clear. So, again, if you're importing from that region, about 3/4 of most of it goes to Asia, I think you're looking at a sustained shock that doesn't really fully revert.
What are you paying for gasoline on the West Coast right now?
I paid $7.50 a gallon on coastal California. Inland California is $5.50.
Wow.
So I'm not sure what that tells you about California, but yes, a triple-digit bill to to fill up the family SUV the other day.
Brutal. David, it's good to see you. Thanks for dropping by. Thank you, sir. David Stubbs there of AlphaCore. We talk about the average in this country, $4 per gallon. I'm sure the Brits are laughing because it's brutal over there right now, particularly in the other European nations too. But the difference you see across this nation, the West Coast, coastal California, pushing $7 plus in some places.
Yeah, does this end up encouraging some politicians to remove some of the gas taxes that have been put in certain places, given the affordability issues for a lot of them?
I think California needs to remember they shut down refineries. They only have one pipeline. They get 20% of their products imports from places like Asia, which right now are winding down their economies because they don't have the energy. So they're in a really tough spot.
Let's give an update on News Worldwide this morning. Let's get to your Bloomberg brief. Yahira has more. Hey, Yahira.
Hi, John. In a primetime address, President Trump saying the U.S. is very close to completing its military objectives in Iran and vowing to hit the nation, quote, extremely hard over the next 2 to 3 weeks. Still, the speech lacked new announcements and most notably a precise timeline for an exit. President Trump also saying in the address other countries need to take the lead on reopening the Straits of Hormuz. The president saying the U.S. does not need the oil exported through the critical waterway and that the nations who depend on it should, quote, go in and take it. And President Trump busy yesterday, becoming the first sitting president to attend Supreme Court oral arguments as the justices considered a challenge to his executive order restricting automatic birthright citizenship. The court is scheduled to rule by early July. That's your Bloomberg brief. John.
Yahira, thank you. More from Yahira later this hour. Up next on the programme, staying on track in Iran.
We are on track to complete all of America's military objectives shortly, very shortly. We're going to hit them extremely hard over the next 2 to 3 weeks. When this conflict is over, the Strait will open up naturally.
Up next, we'll catch up with Ed Mills of Raymond James, live from New York City this morning. Good morning. The problems persist. Even if this goes on for 2-3 weeks and it ends right there. This from HSBC. Even if the Strait of Hormuz were to reopen soon, it would take months for supply to normalise, and damaged natural gas infrastructure now means it's already a medium-term story. And that's what this market's starting to price in slowly again. Equity futures down by more than 1% on the S&P 500, the Nasdaq down by 1.7%. In the bond market, this is where things get really confusing again in fixed income because the data this week has been better than expected. As Lisa pointed out, the ISM came with higher prices. Yields are up again by 4 basis points, 10s at 436, 2s at 383.
Although, interestingly, you're not necessarily seeing rate hikes getting priced back into the futures curve for the Federal Reserve. So it's not necessarily a rate hike type of inflationary impulse. How quickly, though, can this Federal Reserve cut rates? A real question mark now, given the inflationary shock and, frankly, an economy that is resilient enough to absorb them, and that is the key point.
Brent crude this morning, check it out, up by more than 7% on Brent crude to 108.60 on Brent so far this morning. Under surveillance this morning, staying on track in Iran.
We are on track to complete all of America's military objectives shortly, very shortly. We're going to hit them extremely hard over the next 2 to 3 weeks. Regime change was not our goal. We never said regime change, but regime change has occurred. When this conflict is over, the Strait will open up naturally. Gas prices will rapidly come back down. Stock prices will rapidly go back up.
So here's the latest this morning. The president stirring investor anxiety, pledging more aggressive action in Iran without concrete steps to reopen the Strait of Hormuz. Ed Mills of Raymond James writing, the clear desire of the US and Iran to wind down the war will need to be reconciled within the very narrow diplomatic pathway. Ed joins us now for more. Ed, welcome to the programme. Can you describe to us, in a way you've described it to clients, what the next 2 to 3 weeks might look like?
Yeah, John, I think that there's going to be an intensity of the operations. I think there is a higher probability of a ground operation, I think, that the market is prepared for. At Raymond James, we've been highlighting to clients that it will take a while for things to return to normal once the Straits of Hormuz has reopened. Our energy team has been doing a considerable amount of work on that. And I do think that there has been an expectation in this market that things were going to go faster, quicker, and cleaner than expected. And we have been telling folks some cynicism here has been warranted And the cynicism has actually been the thing that has played out consistently over this last month.
And when you say ground operation, do you mean to open up the Strait of Hormuz for normal traffic, or do you mean for military boots on the ground to go seize the uranium?
I think, Annmarie, that's to be determined. I do think that there is a history of President Trump. Once he has built up a military capability, he uses that military capability. So when we see how many troops have been positioned in the area, I do think that there is a obvious desire to reopen the Straits of Hormuz. But President Trump last night did talk about that as something more natural than kinetic. There has been these conversations about the potential operations to seize uranium. To me, that's probably the higher probability. I don't know exactly how robust that is going to be. I think some of that is to be determined. But very clearly, Annmarie, here, President Trump is building up pressure and was telling even the kind of Iranians last night, they have a choice still here that the operations can get much more intense unless they negotiate.
And why give this speech last night? It felt like the tone of this speech was trying to get the American people on board that maybe it should have been given the first week or two of the operation.
Yeah, Annmarie, that's what we were discussing internally here at Raymond James, because I think there was a hope and an expectation that a speech a month into this was a speech to wrap it up. The tone of the speech was the first real rationalization directly from President Trump speaking to the American people of exactly why, and almost preparing the American people for what comes next. When you have all of those comparisons to the lengths of other wars, it is somewhat ominous. We are hopeful that this is 2 to 3 weeks from now, but there's no guarantees. I think that there was a hope that it was only going to be kind of less than a month when this started a month ago. Now we're already extending those timelines. So making that pitch to the American people, because things are probably going to escalate before they de-escalate, is kind of my biggest takeaway from that speech, Annmarie.
This, to me, is the key point, Ed, that this was essentially preparing the American people for whatever is to come next. Do you have a sense of what that could look like and how much it will come in concert with United Arab Emirates, with Saudi Arabia, with other alliances?
Yeah, we're seeing kind of more of those alliances take place. We're kind of looking at the fact that Iran, in their initial response, probably kind of drew the region more together than split it. One of the key questions that we've been asking has been, how long does the United States and Israel stay together? Because there is a big concern, especially in the national security community that I talk to, about whether or not the end game for the United States and the end game for Israel are going to be aligned, especially if this goes much longer than mid-April here. And politically, you do want to have those alliances, but usually those alliances happen before an attack. Build those cases, get the American people on board. As we've seen gas prices, as we've seen inflation, as we've seen other impacts of this, as we see a market reaction to that, the American people are going to put more and more pressure on members of Congress and on this administration to wrap this up sooner rather than later.
And let's just stay on international relations. There's a very strange dynamic to the address by the president yesterday, and it's as follows. For a long, long time, this country, successive governments have wanted to keep the likes of China out of these regions, keep them well away, contain any international ambition they might have. And now we're almost inviting them in to help solve a problem. Do we really want the Chinese military in the Strait of Hormuz?
No. And I, when we've talked to some of the national security advisors and kind of China contacts that we have, there is almost zero expectation that the Chinese military will be involved. But you do have the fact that Trump and Xi will ultimately meet here over the next month and a half. And, Trump always pulls things together. And to the extent that there are things that he is going to be asking China for, China's going to be asking us for, kind of adding in, hey, this is more of your problem than my problem, is really the subcontext of everything that he's saying with the Straits of Hormuz. It's like, yeah, it's a big issue, but maybe China needs this more. Maybe NATO members outside the United States need this more. Maybe France needs this more in particular. Come in, protect that. It is not just our problem. I think this here is a reflection, John, over the fact that he does not feel as if everyone has been willing to rally to his side on what he sees as an existential threat to the United States and to the world.
Ed, it's good to see you. Thank you, sir. Ed Mills there of Raymond James. And you see some of that playing out in the language coming from the president of France a little bit earlier on this morning.
Absolutely. The president of France is basically saying we want to work in cooperation with the Iranians to reopen the strait. Very different from what this White House wants to see.
Up next on the programme, we'll catch up with Stephen Schork of the Schork Group as crude prices get absolutely whipsawed to start the new month. We just put up the biggest two-day rally on the S&P 500 since May of last year, and this morning we're taking some of it back. Equity futures negative here on the S&P by 1.3, on the Nasdaq by 1.7. The leadership in the last 24 hours coming from consumer names and technology, many of which were beaten up quite badly through the month of March. And I imagine today somewhat in reverse. In the bond market, 2s, 10s, 30s, yields shaping up as follows. More data this morning, 2 hours away, jobless claims. Yields this morning up by 3 basis points on 2s to 383.55, 10s to 436. It's a really odd moment, a tense moment in fixed income, given we are considering the hit to growth at the same time. The data is standing up quite well at the moment.
The momentum heading into this shock was strong, and actually stronger than economists expected. If you take a look at the Bloomberg Economic Surprise Index for U.S. economic data, you can see it hit the highest levels going back to 2023. So there was definitely heat in the economy, and you're seeing this from all of these upside beats. Does that mean that we can withstand any kind of growth shock coming from higher oil prices, or does it mean that it will read through to higher inflation and actually pressure yields and prices higher on a consistent level? This is a key question and tension right now in the equity market.
Let's check out crude together. A move of 7 to 8% so far this morning on Brent and WTI. Now, you might be looking at that spread and thinking that's really tight between Brent and WTI right now. Well, one of the contracts is the May contract for WTI. The other one is June. So when we look at Brent, we're looking at June. When we look at WTI, we're looking at May, so just keep that in mind. But ultimately, the trend is clear. Crude is higher this morning. Energy prices are rallying.
And the other trend is clear. It's going higher in the United States. And this is why the president had to address it yesterday. And he said, I know that there's going to be the short-term hit, not just to the stock market, but also your energy prices. Gasoline is going up. Across the country, it's north of $4 a gallon. What happens as we head into peak driving season if that becomes closer to $5? Across the country, we just heard from David Stubbs. He's paying $7 a gallon in California. In California, it's $5.81 a gallon across the entire state, an aggregate. And we are just a month in.
$7 plus on coastal California. These are real numbers, European-style numbers in some cases.
Well, and it shows how connected California, to your point, AMH, how close California is linked to Asian flows and some of the global disruptions, not to mention some of the gas taxes. And I wonder if that's going to become a question.
Brent up, stocks down. How many times have we said that over the last 5 weeks? 3 hours away from the cash open. Let's get some single names, some morning movers. Yohara has more. Hey, Yohara.
Hi, John. That risk-off sentiment that you described is showing up in the Mag 7 after President Trump failed to reassure investors when it comes to the timeline of this war. So that is weighing on the highest growth names in this market as we see yields tick higher. So names like Nvidia and Tesla down about 2.5%. Meanwhile, take a look at the aluminum stocks. They are also falling this morning. On a reporting that the Trump administration is set to overhaul its steel and aluminum tariffs. Raw metals would still face tariffs as high as 50%, while finished goods would be taxed at 25%, but on the full value of the product, meaning that companies may end up paying more overall since the rates will be applied to a bigger base. And we end on Global Star. Those shares are surging 10% in the pre-market on a report in the FT that Amazon is in talks to acquire the company as Amazon tries to compete with SpaceX and its dominant Starlink network. Many have taken notice of this company and its ability to compete with SpaceX, so shares are up 230% over the last year. John?
Yohara, thank you. Thank you for the update. On our radar this morning, in a primetime address, President Trump saying the U.S. is very close to completing its military objectives in Iran and vowing to hit the nation, quote, extremely hard over the next 2 to 3 weeks. The president also declaring other countries need to take the lead on the Strait of Hormuz.
The countries of the world that do receive oil through the Hormuz Strait must take care of that passage. They must cherish it. So to those countries that can't get fuel, many of which refuse to get involved in the decapitation of Iran, I have a suggestion. Number one, buy oil from the United States of America. We have plenty. And number two, go to the Strait and just take it.
The president suggesting the critical waterway would, quote, open up naturally once the conflict with Iran ends. And finally, the Trump administration preparing to outline a tiered system for its broad tariffs on steel and aluminum products, just 1 year on from Liberation Day.
The United States can no longer continue with a policy of unilateral economic surrender. We cannot pay the deficits of Canada, Mexico, and so many other countries. We are finally putting America first. The United States will implement reciprocal tariffs on other nations.
1 year on, Bramo, 12 months is up. What a 12 months has been for the trade story.
So now we're looking at a clarification. This is a simplification of saying you don't have to measure how much steel and aluminum is actually in specific goods and then figure out that that's 50% tax. It gets very confusing. We'll just have a flat tax for 25% finished goods. Taking a step back, this just shows how unstable the parameters are for any kind of policy analysis right now. Sure, we're 1 year on. We're getting clarity on policy. It's still being created. Now we've got an oil shock. How do you analyze all this and understand how to price it into the future if it is changing at such a rapid pace? And this is one of the big challenges right now, to really come up with even a framework to look at the current moment.
Well, the administration is fixing a crisis of their own making. And this has been a massive headache for corporate America when it comes to the derivatives of steel and aluminum in products. So say you're going to import an aluminum pipe. Okay, that's still going to be 50%. But if you have, say, less material in a certain product, that rate's going to drop to 25%. And the real issue for a lot of companies has been something like this. A little aluminum or steel on the cap of a lip gloss. You were getting hit with a crazy tariff. Basically, now they're saying that's going to drop to zero. So this was a crisis in their own making. It's been a problem for corporate America. Corporate America has been lining up at the door of the administration saying you need to simplify it. And they said, oh, look, we heard you. We're simplifying it. Now it's just 3 tiers.
Let's just leave the steel story to one side and just think about the last 12 months. You were in the Rose Garden that day when the president made that address. And initially, we thought maybe it would be a baseline tariff of 10%. And then remember, the market started to rally.
And I sent you a picture.
And then I saw the picture.
These are the real rates.
With these crazy numbers on. And in the weeks after that, before we got some form of capitulation, not total capitulation, but the weeks after that, the forecast was this would lead to really high inflation here in the United States and cause tons of economic problems. 12 months later, we haven't seen a great deal of that relative to what people expected 12 months ago.
No, we haven't. And that's what a lot of individuals in the Federal Reserve have talked about, and a lot of individuals, of course, in the administration, that this has been one-time hits. Companies have been able to deal with it and maybe pass along some of it, and some of it they've been able to just have to absorb. I think what the problem right now is when you're talking about what's going on currently in terms of energy prices is there's really no outline of what can happen, and consumers might just start to make their own decisions without companies being able to really change anything, because discretionary spending, more of that is just going to have to go to energy.
12 months on, we've got another supply-side shock. Crude prices surging as the Strait of Hormuz remains effectively closed. President Trump downplaying the economic fallout of the war so far.
Many Americans have been concerned to see the recent rise in gasoline prices here at home. This short-term increase has been entirely the result of the Iranian regime. When this conflict is over, the Strait will open up naturally. Gas prices will rapidly come back down. Stock prices will rapidly go back up.
Stephen Schork of the Schork Group writing, Hormuz remains at risk and ceasefire prospects are weak, pointing to a prolonged geopolitical disruption to global flows. Stephen joins us now for more. Stephen, welcome to the programme. Let's just run with the base case, as presented by the president. Things can change, I know that, but let's run with 2 to 3 weeks. Where would this energy market be? Where will it be in 2 to 3 weeks?
Yeah, absolutely. So with the rate we're going right now, the way we've modeled it for the next 3 weeks, the current time frame for the spot market right now is $103 a barrel. What was our initial, we'll call it our 1 standard deviation envelope and all of the simulations that we've run in potential price paths. Now that we are well beyond that, what do? We begin to look for that next. And because of the volatility that's been introduced, we have extremely fat tails on the distributions of potential outcomes. 3 weeks hence, we could be looking at $133 in oil. So, John, what we're essentially looking at or doing is the United States, its oil, and the contract that we're following, in this case, NYMEX WTI, that's been the cheapest barrel in the world. Now what's happened is the arbitrage is well established. So now you're having a tremendous amount of buying interest coming in from Asia, coming in from Europe, and hence we've been the cheapest barrel. But because of that buying interest, because you just can't get oil from Asian refiner from your typical sources, you're going to start bidding that oil higher. And that's what I think we're starting to see in the Gulf Coast, is that U.S. prices have been suppressed over the past 4 weeks, but that now it's starting to catch up to reality. And therefore, over the next 3 weeks, as this disruption continues, certainly the path is higher to our second tier envelope, which is, like I said, $134 a barrel.
Is that high enough to cause demand destruction for people to pull back on their use of oil or their ability to get oil enough to get oil prices back lower in the near term?
Based on recent observations and economic theory, no, it's not there yet. We have to keep in mind that demand elasticities for gasoline have changed tremendously. I'll give myself as an example. I drive a plug-in electric hybrid. I fill my car up about once every 2 to 3 months. Now, juxtapose this back to 2008, when oil prices peaked at $149 a barrel. I was filling my SUV up every single week. So that was an incredible pain point. That has changed over the last 15 years. So that part was, so what has happened is back then, if we adjust for inflation, $3.60 at the pump was that pressure point. That's that inflection point where demand started to fall off. We are higher because we've introduced more variables into the equation. So based on what we've seen recently, i.e., we're still $1 below a gallon where we were in 2022, and that did not destroy demand. So we'll look to see oil prices up of $150, $160 a barrel before I think we start to see the market correct and demand destruction kick in.
Stephen, are we done, you think, with verbal intervention? Has it run its course?
Well, are we done verbal? So, trying to jawbone the market or trying to, I don't think so. I mean, I think it's just something as an analyst, as a trader, you just have to endure. And so this is why we look at the spread market. So the forward curve in any given market is your indication of where we're potentially going. And so when we see that, when we look at what has transpired now over the past week in WTI with the curve, that is an extreme bid or price increase on the front end of the curve for those prompt barrels. But that is now also starting to cascade down long from the curve. And then we look at a relationship between WTI, Dubai, or for instance, we have oil production in West Texas delivered into Houston that is trading at a $12 discount to the global price of oil. And that and there's a backwardation along that, meaning that there's a strong bid for West Texas oil, and hence why we're still bullish on this market. And so regardless, you could verbally, you could address in the market and say anything you want. The market is reality. And what the reality is telling us, it's that prices are here higher, and they're going to be higher for longer, certainly over the next 3 weeks.
Will energy companies capitalize by actually reinvesting and expanding production?
Eventually, but what we'll see now, and if you're looking at quarterly earnings for if you are a refiner looked great. I mean, you have diesel fuel that's trading at $170 a barrel against $100 crude oil, or gasoline trading at $130 a barrel against $100 oil. So the refinery margins are going to look extremely great coming through the first quarter. Now, as we transition to the second quarter, as we've said, that U.S. prices are starting to catch up. So that is going to be a bigger hit now. That is what has been a boon for Gulf Coast refineries, that wide margin between product prices and crude oil prices. That's catching up, and oil prices are catching up, and that's going to begin to squeeze margins. So we're going to see a lot of volatility. What was good for refiners last quarter is shaping up to be, especially when demand is starting to pick up coming into the second quarter. So you've got the double whammy of domestic oil prices catching up to the global price of oil at a time, second quarter going into summer, where demand for the output of that refinery is going to surge.
Stephen, I don't just want to talk about price, I want to talk about shortages and outright shortages. This from the Australian Prime Minister. We mentioned his comment earlier on today. Over the coming weeks, if you can switch to catching the train or bus or tram to work, do so. The EU Commission suggesting people travel less across Europe. You can track, you've got visibility on the tankers that are arriving and won't be arriving. You can see the cushion that some of these countries have got, the supply they've got, the inventories. How close are we to a shortage where these governments are actively telling the people to stop doing things in the same way that they are in Asia at the moment?
Yeah, absolutely. So looking at the prompt month, which has about 3 more weeks, that time frame that the president supposedly says we're going to be out of there or wrap this up, the market's highly skeptical. So I'll give it that 3-week time range. where we'll start to see certainly economies in the Far East, and now we're starting to see economies, because that Atlantic Basin spread is starting to tighten up, economies in Europe begin to seize up. Here in the United States, oil inventories are sitting at we just got the weekly update yesterday, sitting at a 3-year high. So there is oil here, but the problem is it's not where it needs to be. Yeah. So even though we do have, and the president might want to say buy American oil, that's great. But tanker logistics limitations, there's just a limit to how much that can sate that. So while here in the U.S., as we said, oil prices, or excuse me, oil supplies are fat 3-year highs, they're really beginning to seize up. And that's why we're starting to see the Brent market or WTI now outperforming Brent at this point, because European buyers, refineries are coming out of once they come out of the maintenance season, they're going to be buying a lot more oil, a lot more U.S. oil, but there is a limit to how much. So we are 2 to 3 weeks away from a shortage that we're already seeing that's going to grow exponentially over the next couple of weeks.
Stephen, it's good to see you. Thanks for dropping by and getting us up to speed. Stephen Schork there of the Schork Group with some sobering comments at where we'll be in the next 2 to 3 weeks.
Yeah, and he was primarily talking about the United States, but when you look at Southeast Asia, as you were mentioning, about 90% of all of their oil and gas comes from imports, and they don't have the capital to really invest in supporting that. So that's leading to people staying home. That's leading also to people not being able to fly there. So that's also affecting tourism. It's a double whammy on all sides.
Brent crude around 109. Let's get you an update on stories worldwide with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. The UAE is pushing for the UN to authorize a range of measures, including force, to reopen the Straits of Hormuz. The Gulf nation is calling for the organization to take, quote, immediate action. A virtual meeting will be held today to discuss a plan. GOP leaders striking a deal to reopen the Department of Homeland Security, ending the 6-week-long shutdown. The agreement, which had been rejected by President Trump last week, fully funds the department through September. A vote is expected to come as early as today. And Stellantis is in talks to build EVs in Canada with its Chinese partner Zhejiang Leapmotor. Sources telling us talks are in the early stages, but if they proceed, this would mark the first major auto investment from China after the countries agreed to reduce tariffs on Chinese-made EVs. That's your Bloomberg brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, pushing ahead to payrolls.
You look at certain indicators that would tell you the labor market is super tight. There are labor shortages in certain industries. I think that hiring rate will remain low for the foreseeable future.
Up next, we'll catch up with Nela Richardson of ADP. Live from New York City, you're watching Bloomberg TV. Stocks are declining this morning. We're down by more than 1% on the S&P, negative 1.6 on the Nasdaq, and the bond market yields creeping just a little bit higher, 2s, 10s and 30s, with this move in energy. Crude higher, Brent pushing much higher, higher by around 8% right now, just short of 109. Under surveillance this morning, we're looking ahead to the data, pushing ahead to payrolls.
You look at certain indicators that would tell you the labor market is super tight. There are labor shortages in certain industries. People are saying it's very difficult to find a job, right? And that's why they're not quitting. Before the conflict started, disposable personal income, which is essentially income adjusting for inflation and taxes, was already slowing. I think that hiring rate will remain low for the foreseeable future.
So here's the latest this morning. Traders looking ahead to the March jobs report, with our survey expecting 65,000 jobs to be added. The data will follow an upside surprise in the ADP private payrolls report. Nela Richardson of ADP writing, although hiring has slowed, pay growth has been stable, which helps support consumer spending. Nela joins us now for more. Nela, this is a central question for a lot of people right now. Just how tight is this labour market? Away from payrolls growth, what do you see with things like unemployment, and what do you see with things like wages?
Hi, good morning. I think we have two stories coming out of the labor market. Pretty steady, but lower than we're used to hiring. We have 2 straight months of plus 60,000 private sector hiring in the ADP numbers. But the wage story is telling something entirely different, that there's more tightness than is generally appreciated. We saw pay growth for job changers accelerate in March, going from 6.3 to 6.6%, which doesn't sound like a lot, but in the context of low hiring, it's strong signal that wages are still pretty tight. And when I look at just hourly workers over the last 3 months, wage growth has been higher every single month of 2026 than we've seen in any month of the previous 2 years, suggesting that there is some tightness out there in terms of getting new hires on board.
Nela, this suggests that the labor market's in a much better spot than some people give it credit for, even with these low levels. Does that mean, as John's been talking about, people can go ask for a raise to offset the increase in gas prices?
I wish it was that simple, because even though the labor market has been incredibly resilient, it's incredibly fragmented. Most of the jobs are coming from one sector, healthcare. And that's been the case for the past 2 years. In fact, from 2023 to 2025, 3 out of every 4 new jobs created in this country came from the healthcare sector. If you extend that trend out 10 years, the healthcare sector becomes the dominant sector of the United States. And so this sector is also being defined by low-paying jobs. At the same time, we're seeing some steady hiring. We're also seeing an increase in part-time share. That means people are taking part-time jobs. They might be taking second jobs to make ends meet. These jobs may not be the full-time 401k jobs, and they may not be the jobs that give you bargaining power when it comes to higher salaries.
Nela, what are we going to learn tomorrow when we get the March payrolls report, given that a lot of people say it's already outdated, based on it not taking into effect the full shock that we saw in March?
Yeah, I think we'll always get before a shock as a baseline. We'll see how healthy the labor market was going into that shock. And that's particularly important on Friday, remember, because January and February showed such wide swings in the government data, up so much in January, down so much in February. So March is kind of the referee of the first 2 months of the year. If we see a labor market that looks like consensus, looks like the ADP private sector number, about 60, 65, at least we'll see some corroboration that the labor market was okay going into the shock. And then we can track whether or not this particular shock, the duration, the impact will have a stronghold on hiring. I have to point out in the labor market numbers that we produced on Wednesday, small firms really carried the torch for the labor market. If small firms are generating this growth, if the healthcare sector is generating this growth, there could be some buffer if services are really the stalwarts here.
That is an upside surprise we saw yesterday, and a welcome one at that. Nela, thank you. Nela Richardson there of ADP on the jobs data so far. And your point on the sector stuff, healthcare, expected a snapback in healthcare tomorrow morning.
Yeah, which I guess is a good thing, considering that was the weak spot, but it's a bad thing because it's sort of independent of any kind of cycle. So it's not like you can decide to hire more people because we're all getting older and need to get a lot more health attention.
Yeah, absolutely. The health sector has been the only thing that's really been pulling this market up. The problem the Federal Reserve is going to have, we have slowing labor market and higher energy costs, with every energy analyst saying it's only going to get worse. This is going to be incredibly difficult few months.
Coming up on the program, we'll catch up with Jim Zelter of Apollo, Mike Pyle of BlackRock, Claudia Irigoyen of Bank of America, and a whole lot more. The second hour of Bloomberg Surveillance is just around the corner.
From the market perspective, we are underpricing economic impacts of this energy shock.
There is a little bit too lax thinking around some of the inflation pressures.
A few more weeks of this, we're going to have to take down our GDP forecast.
It might last longer than a lot of us expected originally.
You could open up the strait tomorrow. Impacts are still coming.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your scores look like this. Following the biggest two-day rally on the S&P 500 since May, we're lower across the board. On the S&P, down by 1.2, on the Nasdaq by 1.6. In the bond market, following some pretty decent data in the last 24 hours, yields creeping higher again, up by 5 at the front end of the curve, twos at 385, encouraged by this move in crude. Brent crude up big time this morning following the president's address. We reclaim 109 on Brent. We're higher by 8%.
Yeah, now the question isn't whether the conflict is going to end in the next week or two. It's going to be how much is the escalation going to potentially create some sort of conflagration in the region and potentially damage to regional oil supplies in the meantime, because ultimately that was what the president was preparing us for. I have to say, my mind's spinning. I'm trying to understand exactly how much heat there was in the U.S. economy coming into this, what the shock could mean for it, and exactly how long it can go on before it's irreparable to go back in order to the momentum that we saw beforehand. It is a very difficult scenario to invest in, which is the reason why you see a lot of people sitting on their hands and then these whipsaw movements in markets.
The energy market is focused on the Strait of Hormuz. And yesterday, the president said the Strait must take care of that passage, the individuals who use it, meaning not the United States. And then he said it might just open up naturally. If we learned anything from history, what happened in 2023 with the Red Sea was that we are still not at normal flows of what they were before the Houthis started attacking ships. And the energy crisis in Asia right now is being felt so deeply that we are not feeling it here, but maybe it is going to get a lot worse in the months to come. South Korea's president, in an address to the parliament today, please save every drop of fuel. Don't use it. Take public transportation.
In addition to that, we're also tracking threats to financial institutions. We've seen the reported threats against Goldman Sachs in Paris. This from Citi just moments ago. The Paris employees will be working remotely as a precaution, but also in Frankfurt, employees working remotely Thursday and Friday.
We're looking for more details. We don't know exactly the parameters of this. It shows the second order effects of this, which is questions around terrorism, questions around disruptions to both cybersecurity as well as physical security around the world, given the support of Iran, the way they've operated in the past. Again, this is a deeply uncertain moment. The market wants to look past geopolitics. It's having a hard time doing it.
And what Citi is saying comes after the headquarters of Goldman Sachs in Paris was placed under police surveillance yesterday because of concern when it comes to threats that U.S. authorities believe is linked to an Iranian group.
Equity futures right now in the S&P negative by 1.2%, just about session lows. Coming up this hour, we'll catch up with Jim Zelter of Apollo as the president's address upends risk appetite. Mike Pyle of BlackRock lowering his outlook on U.S. equities, and Irigoyen of Bank of America expecting crude to remain in triple digits for the remainder of the year. We begin this hour with stocks falling following the president's shift from a near end to the war to now committing to more aggressive action against Iran over the next 2 to 3 weeks. The president of Apollo Global Management, Jim Zelter, joins us now for more. Jim, good morning.
Good morning, John.
We have got a lot to cover. What interesting times. You've called this a confidence shock. A confidence shock. What does that mean for growth?
Well, I think, and I was listening to this show the last 30, 40 minutes, and I've been doing this a long time, and I sometimes think sometimes there's days where you should just go out and just take a walk around for 30 minutes, because I think we've lost the plot.
It's not that bad.
I think we've lost the plot on two big themes. The first is what's really going on in the world of credit, which I'm sure we'll talk about. And the second is the economic strength of the underlying economy. Certainly, we have a very challenging issue with what's going on in the Middle East right now with this conflict, and I'm suspicious of it ending in 2 or 3 weeks, as many others are. But you just had a quarter with record M&A, literally record M&A in the United States and globally, and we had the biggest IG issuance almost of all time. Those are two indicators of a lot of economic tailwinds along with the CapEx cycle. So I think we lost the plot on the underlying economic strength coming into this thing. The second, I would say, we've really lost the plot on credit. We're talking, the headlines and the conversations are about this little narrow area of direct lending, 200 billion of the non-traded BDCs. And why are we here in the first place? The reality is the last 15 years, credit has compounded great returns for investors around the globe, and they've done it in a manner which beats the high yield and loan indexes dramatically. And so we're talking about a little bit of skirmish on the sidelines here. So, no doubt a big macro crossroads in terms of the timing of this and the impact of crude. and what that's going to do on consumer confidence and unemployment. But I think we missed the plot on two big issues, and I suspect if I'm sitting here in 3 to 6 months, we'll be talking about a much, much different backdrop, and we'll be talking about more about the M&A calendar, the IG calendar, the strength of the overall CapEx cycle than we are what's going on in the Middle East.
Well, let's talk about what you called a skirmish in private credit. So
Yeah.
let's get to that. So
Sure.
Apollo Debt Solutions, cap redemptions at 5%.
Yeah.
Understand that clients sought to redeem about 11.2%. When you get those kind of redemptions, how does it work internally? How do you decide what you're going to cap? What do you do?
It's pretty easy. When we created the whole theme of these vehicles were to give global wealth investors an opportunity to be in a robust asset class with incremental yield over the last decade or so. Institutions have clamored to get into it as they took their equity risk down. And so when these products were created, they were created with the premise of you get higher returns, robust compounding yield, but we are going to protect the vehicle from the run on the bank mentality and that type of activity. And so on page 1 in black and white, it talks about a 5% redemption structure of the portfolio to protect all the investors, not just the 5%, but the 95% they're staying. So for us, it's a very easy conversation. The document said 5%. We told folks 5%. We're giving 5%. And so the idea that this is this term of a gate or redemption penalty, this is common structure and common practice. So we're not doing anything punitive. We're doing what's right as a fiduciary. So it's actually a quite easy conversation.
Is it making it more difficult, though, to raise new money for new funds?
You know, I think when you sit back and you see the headlines of the concerns and consternation of where we are in the credit cycle, investors will say, does this make sense for my portfolio? And yes, subscriptions of new capital have come down from the pace that they were last year. But as John mentioned, the first quarter we had as much money coming in as wanted to redeem. So we were in that fortunate spot because of the nature of how we've run the portfolio. A BDC structure is like a hedge fund or like a mutual fund. It's just a structure. Then all the choices are how you invest it, how you structure it. We've been pretty consistent, low leverage, all 100% senior secured, no PIK. So no doubt, I think investors are going to be a little bit more cautious about how they asset allocate. But I really go back to this first comment. The last 15 years, since 2009, credit, depending on where you've been in private direct lending, probably a 9.5% return versus being in the public safe high yield at around 6.5%. That compounding has made a tremendous amount of difference. It's worked for institutional investors around the globe. They want to put more capital in. So if it didn't work, those investors wouldn't be asking for it.
We have seen that, though, over a period of time where we haven't seen a true credit cycle.
Yeah.
And we've seen that over a period where we haven't seen the same kind of build out of private credit the way that we have. And we've seen that during an era of prosperity for the Middle East, which has pumped money into this industry. And now a lot of nations have to use that money to go into infrastructure and protecting themselves and propping up their economies. How much does that potentially challenge the credit cycle and challenge the industry from a cyclical perspective, not necessarily just these one-off issues in BDCs?
I think you're pulling at the thread of the secular backdrop of credit. When I got to Apollo 20 years ago, investors had a very easy choice. They invested in equities or they invested in private equity, and they did other things around the edges. But really for credit, it was high yield or distressed. It was a very binary decision, yes or no. The last 15 years around the globe, as the globe has gotten older, more and more folks are hitting retirement age. The need for income, the need for yield, and taking that equity risk down is a broader secular theme, literally around the globe. And no doubt the big sovereigns in the Middle East have been big players in a lot of these activities. And certainly when this conflict ends, they're going to need to focus on the CapEx at home, in Saudi, in the UAE, in Qatar, et cetera. But I don't think that might have some marginal impact. But, and to your other point, it has been, other than the COVID period, we really have not had an economic slowdown in the U.S. since 2009. That would be the longest cycle post-World War II that we've ever had, almost 17 years. I'll remind you, I was in Australia last week. They haven't had an economic cycle since '92. So the reality is the way the world has, grown, globalization, interactive trade around the globe, it's made economic cycles much, much longer, much more durable, and it's made recessions harder to come by. But I will add, in the last 17 years, you had a huge issue on energy in terms of the shale crisis, a lot of credit losses there. You had a lot of losses in pharma roll-up. You had the crypto bubble crisis. So you've had a lot of sector issues, but the underlying strength, again, when you look at the breadth of this CapEx cycle, the M&A cycle, the IG cycle, I think there's some really, really strong secular tailwinds that, again, I think this is a moment in time in this conflict. I think as I sit here in September and October, this will be in the rearview mirror. I'm sure oil prices will be a little bit lower at that point in time. And I think the year ends up in a much stronger spot than we are right now. It's pretty challenging right now. I would encourage all three of you to go for a walk this afternoon. It's springtime in New York.
Do you not need to rethink some of your strategic partnerships in the UAE? You're dealing with a lot of real estate companies. You're dealing with Mubadala, sovereign wealth fund.
Yes, we do, because I think their needs are going to change. They're going to need to focus on the domestic CapEx and domestic FDI. We've actually been a fairly large player in FDI in the UAE and in other spots in that region, so we're going to continue that. There's a tremendous amount of, whether it's airports, infrastructure, AI data centers, that they're going to need foreign capital too. So yes, I mean, certainly when we think about our investment grade solutions toolbox, we want to take that to that part of the globe. But I've seen nothing out of their actions over the last 6-8 weeks that have taken them off their broader investment objectives.
Can we finish on inflation?
Sure.
If you're so bullish on growth right now, so constructive at the moment, do you think people are underplaying the risk that we see?
I've been consistent in that. I've been consistent in that. I said that last time I was on the show.
And now we've got an energy shock.
When's the last time you bought something that was cheaper 3 to 6 months ago and then you bought it today? I mean, very little.
A long time.
So I think that any conversation of the Fed lowering rates in the short term, I think that's dissipated for the right reasons. I think inflation and stagflation is a little bit of the concern. But I'm definitely much more focused on either back-end inflation or a steeper curve when I think about risk analysis across the portfolio.
Jim, you're going to stick with us. Don't go anywhere.
Sure.
Don't go for a walk. Jim Zelter of Apollo Global Management. I might go for a walk.
I was going to say.
Sounds beautiful, doesn't it?
You know,
I'd love
honestly,
to start my day with a walk.
All I can say is, please, I actually like his advice. And frankly, I could use a walk. So maybe I'll go for one right now.
cherry blossoms, you know.
It's beautiful.
Starting to come through, taking a bit of
little perspective, take a step back, look at the big picture.
I'm trying, Jim. I always try. You know that. Thank you very much. He's going to stick with us. I can't work out if this is an endorsement of this programme or not.
Well, I think he's saying that we're being a little histrionic when it comes to how dramatic we feel the moment is and how potentially bad it could get. And I think that our job is to work through the parameters, and the parameters could get pretty negative. And Jim is saying there's a lot of positivity on the other side. Go take a walk.
You ever met Jeff Curry over at Carlisle?
Yes, and
you guys shouldn't speak.
I've been doing this for 41 years. You don't get to my spot in business by being naive. I'm not naive. I'm very cognizant of the day-to-day issues that we're confronting, with the situation this administration's in, the gravity of the war, the concerns what's going on in Paris. These are some devastating issues. I'm not denying any of those, but I really think, again, I'm using a little bit of the page of the SVB book. We were all convinced after SVB that a massive credit tightening was going to happen in the economy, and we missed it. And the strength of this economy, the strength of the consumer, the CapEx cycle, M&A, those are very powerful drivers.
We appreciate the constructive outlook. More from Jim in just a moment. Let's get you an update on stories worldwide with your Bloomberg brief. Yahira has more. Hey, Yahira.
Hi, John. In a primetime address, President Trump saying the U.S. is very close to completing its military objectives in Iran and vowing to hit the nation, quote, extremely hard over the next 2 to 3 weeks. Still, the speech lacked new announcements and most notably a precise timeline for an exit. President Trump also saying in the address other countries need to take the lead on reopening the Strait of Hormuz. The president saying the U.S. does not need the oil exported through the critical waterway and that the nations who depend on it should, quote, go in and take it. And the headquarters of Goldman Sachs in Paris was placed under police surveillance last night following bomb threats believed to be from an Iranian group. The threats come just days after a bombing attempt was foiled near the Bank of America in the French capital, city telling its Paris and Frankfurt employees to work remotely as a precaution. That's your Bloomberg Brief. John?
Yahara, thank you. They are concerning headlines. We'll keep tracking that story for you throughout this morning. Up next on the program, turning up the pressure on Iran.
We are on track to complete all of America's military objectives shortly, very shortly. We're going to hit them extremely hard over the next 2 to 3 weeks. When this conflict is over, the strait will open up naturally.
Up next, we'll catch up with Bloomberg's Tyler Kendall. We'll have more from Jim Zelter. Bramo's going to talk to him in the commercial break. By the time that's finished, he'll come back a different man. From New York City this morning, good morning. I can tell you it didn't work, in case you were wondering.
I think he's more fired up.
I tried.
No, he's more fired up. He's more fired up.
You've got some concerns.
Yes, I have some concerns. I'm an investor in the world. I have a lot of concerns.
Okay, John.
It's not about the little narrow. It's not about the little narrow corner of the world that you guys call private credit. It's much broader. But
seemed round up this morning.
Pardon?
Have you been annoyed by the coverage in the last few months?
No, I'm not annoyed by it. I think it reminds me of when I was a young high-yield trader in the early 90s. And when 1990, when Drexel went filed, and there was concerns about the high-yield asset class, junk bonds, you know, asset class won't survive. It's a Ponzi scheme. There's no credibility here. And I think that if I look back at that time, it was early days of the high-yield market, which is now the high-yield market and a legitimate asset class. I think this is just growing pains. And as I go back to my first principles, if investors over 15 years were not actually making money, and I see the demographics of the globe right now where investors need robust compounding yield, I'd be concerned. But I see the great benefit of this product.
I've sensed frustration. I've sensed frustration from the asset managers. You have too. I can feel it now. I've got to be honest with you. I can sense the frustration that you've got, I think, with some of the coverage over the past few months. What is it about the coverage that's been quite upsetting? The fixation on just BDCs and not the broader asset class? What is it about that's upset you and the team, maybe?
Well, I got to push back on being upset. I
can tell you over the last few minutes it's felt that way.
Okay.
Maybe not aimed directly at us, but certainly the coverage of your world.
Well, I think that a lot, because of the proliferation of the analysis in every corner of the environment we work in right now, I think that's why I had my message about taking a step back. You know, I do think when you look at the growth of the U.S. economy since '09, the result has been we have the most robust banking system in the world. We have the leading banks that are well-run organizations that have done an amazing job, and the return on equity and their impact in the U.S. economy is profound. You also have a backdrop of economic growth that is unmatched around the globe, and I don't think it's any surprise that the advent of pushing out the risk in the banking system, the benefit of securitization, the benefit of CLOs, the benefit of all the things that institutions have helped out with, that has resulted in a much broader, deeper base financing environment. We financed a lot of growth. We financed amazing tech growth. Our VC marketplace is the most robust in the world. And so I think that, you know, many mutual funds today, I'll give you a little analysis. Many mutual funds today were very, very forward-thinking and were able to buy SpaceX several years ago. And so SpaceX is part of their portfolio, a small portion. There's probably not a clearly defined marking process on how they all mark their SpaceX equity because of employee sales, whether it's monthly, quarterly, whatever it is. But just because the marking process may be inconsistent, that shouldn't stop them from buying a great American company that they're going to do very, very well on. And so that's why I think we're sort of missing the plot about, I've talked on this show in the past about Berkshire Hathaway, about half of their portfolio being in private companies. And so I do think the whole idea of the public-private convergence, the broader portfolio approach, where the market's going in terms of these massive capex, that's where I think we've sort of lost the plot a little bit. And again, I'm not in the newspaper business, but I do think that I know what sells headlines. And I think the methodical, robust growth of the U.S. economy, the role of the public-private convergence, the strength and breadth of our financing, that's really the bigger story here.
And clearly there are people who want to belittle or demean this industry because they feel like either they've been left behind or they want to suppress prices so they can get in and buy. And I just wonder, from your perspective, are you seeing this as an opportunity to get more aggressive, considering that there have been some discounted assets, there are some weaker hands, and a lot of people are worried, including myself?
Well, unfortunately, I would say two things. In my 41 years in the industry, in the 20 years at Apollo, whenever there's been any kind of dislocation, we've been fortunate enough, between the breadth and the discipline and the capital we have, to end up in a better spot. That's number one. The second is, I would say, is the headlines have been much more profound and loud than the activity. There really isn't a lot of assets that are for sale that have widened out dramatically. The high-grade index is where it's been. The high-yield index has really been pretty tight. There's been a variety of financings done. Look what JP Morgan did on EA Sports. They did a massive IG crossover financing. The high yield and loan markets have been pretty strong. So there's been a great excitement about putting this massive amount of capital to work. That's the business we're in. We really have not seen the vast majority of assets coming to marketplace that people have talked about. So, you know, we have a lot of liquidity. We've got $125 billion of capital and liquidity ready to put in the market in our platform, but I'm sure we'll be active, and I'll talk about it on the several times I'm back here the rest of the year.
Final question.
Yes, sir.
Texas or Florida?
You know, we want to, we love New York. New York has been our home for a long time, and we're going to maintain a massive presence in New York.
Do you feel loved by New York?
You know, New York is a very dynamic place that will always attract a lot of best and the brightest of young folks. But we want to make sure, as we think about our company, between New York, Des Moines, El Segundo, we want to make sure we have a spot to create growth and innovation, and we'll see what the process leads us to.
Let's go for a walk together.
Sounds
we can
great.
do that in a moment. Jim Zelter, it's good to see you, sir.
I believe it.
Thank you. Jim Zelter of Apollo Global Management. Jim, this was fun. We appreciate your time.
Always appreciate
Thank
being
you
here.
very much. A stern defense of his asset class. No doubt expected by many.
Yeah. Well, and saying that really you haven't seen the actual pain in terms of fire sales or any kind of assets on the market. The broader takeaway to me is the economy is going to be in a robust place in October, September, come when this is in the rearview mirror. And it speaks to some of the upside surprise that we've seen in economic growth. Also speaks to the reason why some people are worried about inflation.
Do you remember a long time ago, if you got the tap on the shoulder and you were asked to move outside of the New York office to somewhere else, it felt like a punishment. And now it feels like a reward. Can you imagine the line as some of these financial institutions to get on board, jump ship, and go somewhere else?
Well, and that is part of the reason why they're moving to other places and why you're seeing those locations surge.
Walks in Miami.
Right? You know?
Much better, at least.
Run out of time, but I do wonder how many people knocked the door and said, you know what, Jim, I fancy some of that.
I would like...
I'll see you down in Florida.
I would like to hear the New York response.
Yes.
You know, what does New York City have to say to that?
Coming up on the programme, Mike Pyle of BlackRock, lowering his outlook for US equities, plus Danny has your morning movers. Higher fuel prices weighing on airline stocks this morning. Stocks down across the board. New session lows on the S&P. We're negative by 1.5% on the S&P 500. From New York City, you're watching Bloomberg TV. Let's sit on this price action just for a beat. Equities down across the board on the S&P 500. We're down by 1.5% on the S&P. Jim Zelter's taking a walk. That's why he's so chill.
I mean, he gets a chance to take a walk. In fairness, he wasn't.
Think he's ever coming back?
Don't listen, Jim. The Nasdaq's down 2%. In the bond market, 2s, 10s, 30s look like this. He's a good sport. Yields are up by 5 basis points on 10s, 437. 2s up by 5, 385. Encouraged by this move here in crude. WTI and Brent advancing this morning. Brent crude just short of 110 now, 109.55 and up by more than 8%. The president's address, for many of you, falling short. Didn't have new information. And I keep going back to the two key issues for this market right now. End the hostilities, get the energy moving. And there's nothing that we've heard in the last 24 hours that suggests that one or the other is going to happen anytime soon.
People were expecting this to be some sort of explanation of how the U.S. was going to extricate itself from Iran based on some of the recent posts that we've seen on Truth Social. Instead, it was preparing the American people for a greater escalation, which is a reason why you're seeing a response this morning. Again, how many days do we have to come in and say, well, everything's changed now that there's a new post or there's a new comment? And that is sort of a question. At what point do we reach the place where there's sort of diminishing returns for some of these macro headlines that keep whipsawing everything?
When it comes to the Strait of Hormuz, the president gave no indication that the U.S. government is going to be the ones to reopen it via militarily. And then we hear from Emmanuel Macron of France saying it would be, quote, unrealistic to try to open it through military means. And they say we need to cooperate with the Iranians, who right now the United States is having strikes on.
The next phase for all of this is the data, the economic data and the earnings, the guidance coming from corporate America and elsewhere. We've got more economic data for you now. Mike McKee has more. Good morning, Mike.
Good morning, John. Well, it is sort of guidance. The Challenger job cuts numbers are just out. Now, these don't all happen, but they do give us an indication of what the corporate offices are thinking. And we see 60,620 job cuts announced in the month of March. Now, that is down 78% from the same month a year ago. However, if you look industry by industry, technology getting whacked. 18,720 jobs announced to be cut in March. A total for 52,050 for the year so far. The next biggest is pharmaceutical, and that's only 6,348 for the year so far. Manufacturing jobs continue to go away. But if you want a job that doesn't seem to be threatened at the moment, become a lawyer. The legal industry, no job cuts in March, none announced year to date, which is kind of interesting because everybody says AI is going to get rid of a lot of people in the legal industry. It seems to be doing much more to those who are creating AI than to those who are going to be using it.
Like it's always the way, when things start to get bad, they make money. Mike McKee. Thank you, sir. The latest on the jobs data. More tomorrow morning at 8:30 Eastern Time with the payrolls report. ADP was decent. Retail sales were decent. ISM, the headline was decent. You noted prices paid. That might be of more of a concern in the months to come if that holds.
Yeah, the idea that you see prices paid increasing to the highest pace since 2022. I just find it interesting that this highlights how companies are shifting budgets toward AI investments at the expense of jobs. That's according to the head of the Challenger jobs cuts announcements. And again, this is the existential risk behind all of this. We're leveraged on a bet tied to artificial intelligence that will prop us up through any kind of potential shock. At what point do we see that percolating into other issues that affect the economy? And this is the reason why people get negative. They start to put all these things together and it becomes a toxic
your own
brew.
negativity.
Well, I don't want to question my own negativity. I never want to question that. But I do think that Jim Zelter is onto something when you actually look at the upside surprises in a lot of the economic data that we've gotten.
Data's good. Capital markets have been wide open. From Jim's seat, I see the same thing. That makes a lot of sense. If you're in a political seat right now, I'd be far more concerned. Gasoline prices, $4 a gallon. The trends you're talking about in the labour market. Try getting elected on those kind of trends. That doesn't look good for me going into the midterms.
I'm more worried about the sovereign debt market, frankly, because given the fact that everyone's going to be trying to prop up a lot of the incomes of individuals, both in the United States and elsewhere, how much is that the real issue? More fiscal spending and what that does to the yield curve.
And when it comes to trying to get elected, if you look at the latest Reuters Ipsos poll this week, 2/3 of Americans want a quick end to the Iran war. We did not get that last night from the president.
OK, you ready? You feel more comfortable now? Good. Feel comfortable in your negativity.
I want to go for a walk. No, I mean,
that's
a contradiction.
He's in a different seat to us.
No.
He gets to go for a walk.
I mean, being comfortable in your own negativity.
Oh, right, sure.
Like permanent uncomfort.
All right.
Let's move on.
On a radar this morning, the president indicating the war in Iran is nearing completion.
We are going to finish the job, and we're going to finish it very fast. We're getting very close. I want to thank our allies in the Middle East, Israel, Saudi Arabia, Qatar, the UAE, Kuwait, and Bahrain. They've been great, and we will not let them get hurt or fail in any way, shape, or form.
The president later pledging more aggressive action in the coming weeks, including potential strikes on Iran's electrical plants.
If there is no deal, we are going to hit each and every one of their electric generating plants very hard and probably simultaneously. We have not hit their oil, even though that's the easiest target of all, but we could hit it and it would be gone, and there's not a thing they could do about it.
Some of those comments from the president sending equity futures lower and crude prices much higher. And finally, a concerning story developing. The Goldman Sachs headquarters in Paris receiving bomb threats overnight. This just days after a failed bombing attempt near the Bank of America office in the French capital. Citi telling employees in Paris and Frankfurt to work remotely as a precaution.
Hugely concerning. The reports say that this is tied to a threat coming from Iranian-backed groups or groups that are pro-Iran. Again, this is not just an isolated story to the Middle East, to a specific region. This is the new type of warfare, and it is warfare with a nation that is engaged in a lot of cells around the world to engage in terrorist acts. So definitely something that's hugely concerning, and we'll keep monitoring it.
And Europe is obviously bracing for this. The Paris police saying they're tightening security around U.S. banks. You have bank CEOs saying just don't go to work. How long is this going to last? It's a serious concern.
We'll keep tracking those headlines as they come in. Yahara is going to stay on top of that story for you. Let's stay on our top story this morning for financial markets worldwide. The president's address on the war in Iran, weighing on risk appetite and whipsawing financial markets. Mike Pyle of BlackRock writing, we think the shock in energy is not fully reflected. We're recommending dialing back risk in global equities. We've trimmed our overweights to the US and Japan to neutral. Mike joins us now for more. Mike, good morning.
Great to be here.
Let's talk about why you believe it's not well priced. What is the risk that you don't think is sufficiently priced at the moment?
Yeah, I mean, I think as you were talking about in the lead-in, that duration of disruption to global energy supplies is the core question, and it looks as if it's going to continue to cascade for some number of weeks, if not months, from here. That is a core risk to the global economy, and one that I think has caused our portfolio managers to be dialing back risk, just more to that neutral position.
You're tracking how the dominoes fall. Just describe how that will cascade in the weeks to come. Now, the president's essentially told us, and we can go with this as a baseline assumption, this will continue at least 2 to 3 weeks.
Yeah, I mean, I'd say maybe a couple of things. One, when it comes to the geopolitics, when it comes to when energy is going to be restarted, I've got my eyes on two things now coming out of the president's remarks. One, that mid-May date when the Xi-Trump summit has been scheduled, May 14th, May 15th. I don't think they're going to want to reschedule that again. That's obviously very important to the president, to U.S.-China relations. I think as I look out there, that looks to be something of a backstop for the length of hostilities here. Secondly, the UK foreign secretaries convening 35 countries in London today. I think a broader set of countries around political, diplomatic, military steps are going to be a part of a solution to the Strait of Hormuz, and I think that those discussions are happening is important. So those are two things in light of the president's remarks I've got my eyes on. I think to your question, this has already now been going on 4 to 5 weeks. It's going to take weeks, if not months, to restart, and we've got cascading issues as a result. I think, what am I looking at? I'm looking at not just the headline prices of crude. I'm looking at a lot of those spreads to the refined products, to things like diesel, to things like jet fuel, to things like naphtha, where we're really seeing signs of physical supply disruption, demand destruction, especially in Asia, and I think beginning to extend to Europe. And I think those are the places where we're really going to see some of that supply disruption manifesting itself in economic slowdown.
You're talking about going to neutral for both Europe and the United States, even though a lot of people have come on the show and said Europe will be much harder hit, as you were just talking about, as well as Southeast Asia. What's the transmission mechanism for the United States that, given all of the growth that Jim Zelter is talking about, you think could potentially stymie expectations even further from here? Yeah,
I divide that into kind of two parts. One, I think on the real economic side, certainly the U.S. has and is going to have its exposures. This is a global supply shock, but the U.S. is coming into this from a relatively strong economic position, as Jim was talking to, and is relatively more resilient to energy shocks globally. I was talking to Annmarie before we came on air. If you look at the natural gas price in the United States, an important input to electricity, an important input to industrial production in the United States, that basically hasn't moved since the start of the Iran war. Very different than what we saw in 2022. On the flip side, I think there are a set of financial linkages from the United States to the rest of the world, that could be stressed. There are going to be a lot of countries, whether in the Gulf and Europe and Asia, that are having to take resources and invest them at home around their own resilience, around their own defense. Those are financial flows that are an important uplift historically for U.S. equities, for U.S. assets. And I think some of those financial linkages could be a headwind as we look ahead.
Is this a reason why you potentially yields could go even higher in the U.S.? We're talking about equities and Middle East investments in the United States equity market. But what about the fixed income market, given how much they've been also investing there?
Yeah, so I think, we look at the long end of government bond curves. That isn't just in the United States. I think it's across developed markets in general, and see, risks to the upside. Obviously, all of these are markets that came into this conflict with question marks over fiscal, the need to invest. Those question marks, those needs to invest, even greater now. And so I think particularly at that long end, that 10 to 30 year part of those curves, we see risk in the United States, but risk across the developed markets more broadly.
Well, we see structural changes. You brought up something like naphtha. The United States right now is exporting the most on record, 15 million barrels of naphtha last month. That's pretty incredible for the U.S. Does that stay?
Yeah, I mean, I think that that this is a moment that is going to be a pivot point, just as the 2022 invasion was, just as COVID was for supply chains globally. And I think one thing that gets talked about a lot, but I think can't be underscored enough, is the benefits of building resilience through stockpiling. I think that one of the ways in which we're going to see increased spending, increased investment from a range of countries around the world is building these stockpiles around critical inputs, like on energy, like on raw materials. And naphtha is just one example where I would expect to see ongoing demand, because companies are going to want to build those resilient stockpiles in the face of the likelihood of ongoing shock.
It's something, a theme we've heard repeatedly over the last month, that's going to keep prices elevated even after these hostilities end and conclude.
And it's not just in oil prices, it's not just in gas prices, but aluminum, in nickel, in copper. And that's what you see around some of the pricing and the volatility there. How you get a handle on that and what that means for inflation longer term. Again, that's the reason why people are looking at the fiscal budget as well as potentially the price inputs for consumers.
Mike, thoughtful. It always is. It's good to see you. A year since Liberation Day. Where's 12 months gone? It's crazy, isn't it?
Flies by.
1 year on from Liberation Day. Mike Pyle there of BlackRock. 12 months later, we're sitting here trying to work out what the impact of that day is going to be. Still trying to figure things out.
Well, when it comes to tariffs, yeah, because the Supreme Court struck down IEEPA, the administration is working out exactly what the tariff rates are going to be. I just spoke to Jameson Greer about this. They're still working out what the tariff rate is going to be in China. They're trying to get back to that 20%. Can they? We'll see.
That meeting between Xi and the president circled on, I think, most people's calendars going into the month of May. Let's give you an update on stories worldwide this morning with your Bloomberg Brief. Yahira has more. Hey, Yahira.
Hi, John. Great Britain will host talks aimed at forming a coalition of countries to explore ways to reopen the Strait of Hormuz. The virtual meeting will include at least 30 countries, including France, Germany, Italy, Canada, and the UAE. The U.S. is not expected to attend. The headquarters of Goldman Sachs in Paris was placed under police surveillance last night following bomb threats believed to be from an Iranian group. The threats come just days after a bombing attempt was foiled near the office of Bank of America in the French capital. Citi telling its Paris and Frankfurt employees to work remotely as a precaution. And the Wall Street Journal reporting that Maine is poised to freeze large data center construction until November 2027. The bill calls for the pause so the states can assess the impact of data center development on the environment and electricity grid. That's your Bloomberg Brief. John.
Yahara, thank you. Thanks for the update. Update on the markets. Session lows. We're down here by 1.6% on the S&P 500. Up next on the program, a crude awakening.
Many Americans have been concerned to see the recent rise in gasoline prices here at home. Our economy is strong and improving by the day, and it will soon be roaring back like never before. It will top the levels that it was a month ago.
Up next, we'll catch up with Irigoyen of Bank of America Securities, live from New York City. This is Bloomberg Surveillance. Let's get you up to speed on the price action this morning. Equities declining. Decent two-day bounce, the biggest two-day run we've seen on the S&P since May of last year. We take almost all of it back this morning. We're down by 1.6% on the S&P. On the Nasdaq, we're down by 2 percentage points. On the Russell, a similar move. In the bond market, yields pushing higher. It's that toxic brew, as Bramo would call it. Stocks are lower, bonds are lower, yields are higher by 5 basis points, 10's up to 437. And the epicenter of all the price action is this right here. The story hasn't really moved on. Brent crude at 109, up by 8%. And the fact the story hasn't moved on is part of the problem.
Yeah, you can't really discount the idea of higher oil prices. When I look at the price action every single day, I wonder, do traders come in and they're like, oh no, we got to sell, or oh no, I got to buy, or is this just algorithmic trading and programmed trading that's trying to pick up all these headlines, interpret them, and inject, oil prices up, bad, risk on, or risk off, oil prices down, good, risk on. At what point are we just trying to put a narrative to what ultimately is just computers?
Well, the administration is trying to put a little bit of a cap, at least through verbal intervention, on the paper market. The issue is everyone's waking up to the physical market, and the fact that the Strait of Hormuz is still closed 5 weeks in is a huge problem. And right now, the president didn't offer any options besides it naturally opening up or other countries that use it opening up, which Emmanuel Macron to that today says that's unrealistic and it has to be done through consultation with Tehran.
No sign that external partners have the ability to open it up right now. And if they did, no real sign from the president right now that they've got the willingness to do that, at least for the moment. And things can change because guidance has gone back and forth over the last few weeks. For markets, your base case now is this endures, it's prolonged, it goes another 2 to 3 weeks, and the longer the Strait of Hormuz is compromised, the more the problems accumulate. And I think we're already past the point of this being a short-term shock. And that's what I get from the commodity pros at the moment, reading the research on the south side, is this is already a medium-term issue because of the damage done to production across the region.
Which is the reason we're all looking at the economic data. How much momentum do we have going in to withstand the potential shock that clearly is going to be a little bit more significant than a lot of people thought?
Under surveillance this morning, a crude awakening.
Many Americans have been concerned to see the recent rise in gasoline prices here at home. In 1 year, we've taken a dead and crippled country and made it the hottest country anywhere in the world with no inflation. Our economy is strong and improving by the day, and it will soon be roaring back like never before. It will top the levels that it was a month ago.
So here's the latest this morning. Oil prices surging as President Donald Trump vows to increase attacks on Iran. Claudia Irigoyen of Bank of America Securities writing, we now assume the war ends before the end of April, with oil prices around $100 a barrel for the rest of the year. Claudia joins us now for more. Claudia, good morning. Yep. That's quite a headline, because that's not priced into the oil curve right now. When you present that to clients, what kind of pushback do you get?
Well, there is so much uncertainty that people understand that that can be one of the scenarios. I think what the market is not paying enough attention is the persistence of the shock, even if the war ends in 3 or 4 weeks, because you're going to need a lot of time to normalize the flows in the Strait. It's not just about the war is over, it's about normalizing the flows in the Strait. And also you're going to need 3 or 4 months to normalize production. So that creates a lot of persistence and obviously a higher floor for energy prices versus pre-war. And that's the part I think the market is not pricing in totally.
So let's run with that baseline assumption, 100 for the rest of the year.
Yep.
Let's go with that.
Yep.
What does that mean for your expectations for growth and for inflation?
Well, the short answer is lower growth, higher inflation. The question is how much lower, how much higher, which countries are going to suffer more. We are thinking at the global level, we shrug off 0.4 of global growth from 3.5 to 3.1. Inflation is going to go up at the global level 90 basis points in the headline inflation. For you to have a sense, in the US, we expect 40 to 50 basis points, depending on whether you're talking about fourth quarter versus fourth quarter or average growth. 40 to 50 basis points. I would say 30 basis points is because of the oil shock in growth. So reduction in growth, 30 basis points because of the war. And inflation headline should go up in the US, headline PCE 70 basis points and core 30 basis points. But if you compare that shock, the same shock in Europe, where obviously LNG is also very important, growth will go down around 60 basis points. and inflation 160 basis points higher.
Have we already reached the point where certain parts of the world that previously were going to have positive growth are now headed for recession?
I think for that word is probably too early to use it. I think we need some worsening of the price action. If you think about, for instance, the U.S. and the type of growth that you have, that last year was driven by investment, AI mostly, and the K-shape type of consumption where higher and middle income brackets are the ones that are pushing aggregate growth. If you have a correction in asset prices, that through consumer confidence can affect aggregate consumption much more. But if in order to have that, you need to have probably higher oil prices and the prospects that oil prices will remain about, say, 120 for a while. The market has been pretty resilient.
How important is tomorrow's jobs report to you? At what point does the sort of typical economic data matter again versus, say, just the company reports that come out during earnings?
So, I mean, this report is obviously dated because it's information pre-war. It gives you a flavor of where the economy was before the war. These type of shocks, stagflationary shocks, shows up first in inflation and then in economic activity. So you're going to see it in employment maybe in the next 2 to 3 reports. We need to wait. But the inflation numbers, you're going to see it pretty quickly.
Do you think that will shape the sequencing that you just described? Do you think that's going to shape communication from the central bank as well? Do they start out by trying to anchor inflation expectations, knowing that at some point down the line, they've got to respond to growth?
Yeah, absolutely. And over time, you're going to have either good news about the war or bad news about the war. Right? So it's a moving target to some extent. But for instance, at this point, we have the Fed not doing anything for a while, but we have the ECB hiking in June and July.
Wow.
Right? So it's a very different type of dynamic and very different type of management of inflation expectations.
Got 30 seconds left. Do you consider that a policy mistake if they hike twice?
Not necessarily. I think there is so much uncertainty that it's too early to tell that it's a policy mistake. We're talking about June and July. We are beginning of April. This is equivalent in normal times of 3 years, basically. Yep. A lot of things will happen between now and then.
Claudio, it's good to see you. Thanks for being here. Appreciate your time.
My pleasure.
Claudio Irigoyen there of Bank of America Securities looking for, on average, $100 a barrel for the remainder of the year.
Yeah, and the idea that increases headline CPI around the world by 90 basis points, by almost a full percentage point as a response, gives you a sense of how this is increasingly very much an inflationary story.
Coming up on the programme in the next hour, we'll catch up with Sarah Hunt of Alpine Saxon Woods, Roukaya Ibrahim of BCA Research, Alejandra Grindal of Ned Davis Research, and Ohsung Kwon of Wells Fargo. The third hour of Bloomberg Surveillance is just around the corner.
We're sort of signaling caution here. We have not added to equities.
We want to be positioned for a rebound.
The U.S. is the best house in a bad equity neighborhood.
The market as a whole probably still has some mean reversion.
We've got a bullish and bearish tug-of-war going on here.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, and your scores look like this. The losses resume, declining across the board. On the S&P 500, negative by 1.6%, down by 2. On the Nasdaq, in the bond market, bonds down 2, yields higher. 2s, 10s, 30s, yields up by 4 basis points, 4.36. And the epicenter of all of this, guess where it is? It's right here. Brent crude and WTI advancing. Brent crude 109, higher by 8% so far this morning.
The why here is actually really important. Last night we got a speech from President Trump where essentially he was preparing the American people for an escalation to de-escalate. This wasn't a discussion about getting out or how quickly the U.S. is going to remove itself from the region. It was talking about how they're going to insert a lot of pain on Iran in order to reopen the strait and get some concessions. A real question about how long this goes on for, whether people are sufficiently prepared, and how big of a shock this is to an economy that had been pretty resilient going in.
The market was hoping and looking for an off-ramp and said they got to ramp up from the President of the United States, and no indication that a Strait of Hormuz will be opened anytime soon. The President said countries that rely on it, they need to go do that themselves, or it'll just open up naturally. Mark Short, who worked for the President in the first term, had this to say on social media: if the U.S. isn't going to secure the Strait of Hormuz, who is? And the market fully understands that.
The next phase, we've talked about it repeatedly, the economic data, 8:30 Eastern Time. Jobless claims tomorrow morning, 8:30 Eastern Time. The payrolls report. And the data so far this week, better than expected.
Yeah, with the economic surprise index reaching some of the highest levels going back to late 2023. Claudio Irigoyen had a really interesting thing to say, and I just want to pick back up on that. And you were talking about it, the sequencing of this, that we're not going to see the read-through of this shock in the employment market for a couple of different readings. We are going to see the shock show up in prices much more quickly. ISM manufacturing yesterday, we saw the prices paid component rise to the highest level going back to 2022. Watch that data point and the read-through to how people respond to it, including, as you mentioned, central bankers.
Yeah, the sequencing matters. Inflation first, then growth later. Seems to be the view from the Economist at the moment. And which central banks respond? In his view, the Federal Reserve sits it out, doesn't cut interest rates for quite a while. The ECB, they've got 2 hikes from the ECB, the European Central Bank, through the summer.
Even though people are talking about this being an even greater hit to growth than simply just an inflationary shock in places like Europe. Granted, they've got a single mandate to control inflation. You asked Claudio whether that was going to be some sort of policy mistake. A lot of people would say they have made that policy mistake. Please don't make it again. He said it's too early to tell. Nonetheless, the longer this goes on, the more the long-term growth shock is going to come into play. And you're going to start to wonder what the counter effect of hiking rates into that type of a scenario is.
Claudio made another really important point that I think sometimes we forget. Even if the war ends tomorrow, the natural flow of oil and vessels through the Strait of Hormuz will not go back to normal. And the Red Sea is emblematic of that. We are not at normal flows right now from the Red Sea, from the Houthis hitting at vessels since 2023. We are still not back to normal. So I think you need to really recalibrate that. We are really never going back to the old Strait of Hormuz.
Stocks sold this morning. We're negative by 1.6% on the S&P. Coming up this hour, we'll catch up with Sarah Hunt of Alpine, Saxon. Words with stocks retreating on intensifying war rhetoric. Alejandra Grindal of Ned Davis Research breaking down the latest round of jobs data. And Ohsung Kwon of Wells Fargo trimming his year-end S&P target on increasing risk from the war with Iran. We begin this hour with our top story. Equities lower following back-to-back gains, with the president turning up the pressure on Iran once again. Sarah Hunt of Alpine, Saxon. Words writing higher energy prices pose a real challenge to both earnings and the consumer. But given the multiple compression in equity markets, valuations are becoming attractive. Sarah joins us now for more. Sarah, good morning.
Good morning.
Let's start with earnings. Is the outlook for earnings solid, or analysts just really, really slow?
I think that there is a problem with earnings that is going to come through from energy, and it looked like if we were going to get some sort of a change over the last couple of days, maybe that would be okay. I'm starting to think as the oil back curve starts to move higher, I don't see how earnings are going up for 2026. I think that there has to be some sort of a balance, and I don't know where that balance is yet, but I think that we are getting a little over our skis on the earnings.
Begs the question if I should be getting excited about multiple compression with that in mind.
I think, it's amazing you write something a day ago and the next day it's already different, which is why, there's a lot of whiplash going on the narratives. I think that you could see how much the market was anticipating some sort of an off-ramp. It looked like there might be some sort of discussions that might get to something. The fact that we're back in this place a day later tells you that this is going to be, at least for the next foreseeable, whatever future that is, 24 to 48 hours, you are going to have more issues. To your point about trying to get back to normal, I think that because there was normal in the Strait of Hormuz, it was okay that the Red Sea wasn't back to normal. I think there's going to be a huge push to get anything back as soon as you get it open. But when that's going to be, we don't know. The longer that takes, the higher energy prices are. That's going to feed through to earnings, and people are not going to like that. So yes, I think that definitely tempers my enthusiasm for valuation compression, because I don't think that you're going to get a solution as quickly as we thought just a day ago.
So when I hear you talking, I'm like, oh yeah, this is the reason why I'm nervous. And then when I read your commentary, you see opportunities out there. I think, what am I thinking about? I just obviously need to go take a walk. So how do you get the conviction to decide to buy, given the level of uncertainty? Have there really been enough sell-offs in specific sectors or names to justify taking that risk?
I think that's sort of the key, and I loved Jim Zelter on earlier this morning because he was like, take a step back, look, zoom out, because it's also a timing question, right? Over time, we know that market problems eventually get resolved. Am I looking at a 5-year window, a 2-year window, a 6-month window? In a 6-month window, I can see a lot of volatility, and I would not be as sanguine on a 6-month basis as I would be on a longer-term basis. Is there going to be more volatility this year? Yes. Do people are still thinking that we end the year either higher than we are today or sort of flattish to where we started? That's really going to depend on the developments over the next couple of months. And I think that a month ago this was, let's see how long it takes. Well, we're into a period of time now where that compression and just the traffic jam of getting through there is going to be a problem and is going to keep energy levels high. And that's going to be hard for growth. I don't see how that doesn't impact earnings.
So taking a step back, I took a walk and I'm thinking, well, what has structurally changed if you take a look at a 3 to 5 year horizon? And what a lot of people keep saying is maybe not the equity story, not the AI story, but does the bond market story change, given suddenly the renewed need for fiscal, the renewed need to sort of support from a debt financing perspective, a lot of social initiatives that are only getting more current?
Well, that turns into a much longer, deeper discussion about what is the point at which the government can not keep throwing money at things. And at some point, you would think that there is a point at which bonds start to get higher price because everyone's worried about the fiscal. Every time I think that's going to happen, it seems to back off. So I don't know what that point is. Right, but it's true. There should be a point. Maybe that's why gold is sitting at $4,500, because people are going, at some point, every currency has a problem because every government is too indebted. I don't know what that point is, though, and that point keeps moving.
Sarah, why do you think the market is so fixated on Trump's truths and just not looking at what he's doing? Just this week, again, another U.S. aircraft carrier and 2 destroyers were sent again to the region. The troop buildup is consistent, and it's getting higher.
You know, I don't know if people think that that is a strategic move, if that is an actual move, if that is a psyops move. I don't know. And I think that the problem with dealing with a situation like this that's so fluid and everybody has something to say and everybody has an agenda, it makes it really difficult to parse out what's actually going to happen. Maybe we could just be looking threatening. Maybe we're actually going to go and put boots on the ground. People said no, then they said yes, then they said no. I don't know what the answer is, but I think that trying to parse out what's happening from what people are saying is increasingly difficult, and the market is obviously not necessarily buying that to the extent that it was in the beginning.
So where do you hide?
The term hide is such a tough one, because when you're managing money, you have to be managing money, right? But I think this goes back to where we were sort of positioned into the beginning of the year, which is balance sheets, cash flow, all those things really matter. All of the money that is being spent by the Mag 7 has made the Mag 7 less attractive than it was. I think that was a place where people spent a lot of time. There was a lot of money in there. Some of that's come out because people are worried about that spend. There's still a lot of companies that have good cash flow, decent balance sheets, and are doing business that will continue to do it. I think growth is going to slow. It just makes it more tricky.
Nvidia's done nothing now for months. Microsoft was down pretty hard in the month of March. Alphabet down too. Meta down by double digits. What's going on with those names?
I think the big concern is they're all spending a lot of money. They're all spending a lot of money, and we're trying to figure out what the returns on that money are going to be. Right now, since they're all running into it, it was fine for NVIDIA for a while. Then people get worried about it. If you start to see anybody pull back on CapEx, that's going to give that whole sector a scare, because everybody who's spending a lot of money is now borrowing it.
Do you think we're close to that moment, that earnings call, that release?
I think we're closer than we were. I think we're much closer than we were, because you start to see the electricity issues with data centers too, right? Maine just said no data centers for 2 years. We want to see what happens. There is a conflict now between energy and data centers that there wasn't before, that this is just exacerbating. I mean, it was there before, but it wasn't in the headlines in the same way before. And now you're starting to see that. And I think that could kick something like that off, and I think that could be problematic.
Is that the reason why people don't see necessarily big tech being the obvious leader out of this potential rut that we see in the equity market?
I think so, but on the other hand, I would take the counter argument and also say they are in the best position to weather this in the end. So even if they do pull back CapEx, even if people start to get really worried about that, they're still generating a lot of cash. They're going to generate a lot of cash. So to the extent that those multiples have compressed a little bit, that probably makes that part more attractive, because you don't know enough about what's going to happen with some of the other sectors that are pulled back, like software. Although I definitely think that's going to be an and not an or for AI.
Back above 110 on Brent just moments ago. That rally now up by 8% on Brent crude to about 109. Back above 110 on WTI, I should say, up by 10% on the session. So a serious rally starting to build.
And we haven't really seen it go materially in the other direction. The expectation is for escalation before any kind of de-escalation. The growing risk is there could be additional oil facilities hit during this escalatory period.
I know that there are different contracts, and WTI is looking at May, and you pointed out that Brent is at June. But at this moment, that contract for WTI that you're showing on your Bloomberg screen is higher than Brent right now. And you have gasoline prices in America north of $4 a gallon. Potentially, this continues, as the president outlined last night. You are going to see closer to 5 as we go to peak driving season in the United States.
TI right now, 110. We're higher by 10 percentage points on the session so far. Sarah Hunt of Alpine, Saxon Woods. Sarah, good to see you. As always, thanks for dropping by. Let's give an update on stories worldwide with your Bloomberg brief. Yahira has more. Hey, Yahira.
Hi, John. In a primetime address, President Trump saying the U.S. is very close to completing its military objectives in Iran and vowing to hit the nation, quote, extremely hard over the next 2 to 3 weeks. Still, the speech lacked new announcements and, most notably, a precise timeline for an exit. The Trump administration is preparing to outline a tiered system for its tariffs on steel and aluminum products. Sources telling us here at Bloomberg some derivative products will maintain a 50% duty, while many products will be tariffed at a lower 25% rate. And NASA is sending a crew of astronauts towards the moon for the first time in over 50 years. The Artemis II crew has reached stable orbit in space, marking the initial phase of the 10-day mission. The spacecraft is expected to swing around the moon on Monday. That's your Bloomberg brief. John?
Yahira, thank you. Thank you for the update. Session lows here. We're down by 1.7% on the S&P 500. Up next, the Monocores plus Roukaya Ibrahim of BCA Research as crude prices continue to climb. WTI north of 110.
I think there's some really, really strong secular tailwinds. I think this is a moment in time, this conflict. I think as I sit here in September and October, this will be in the rearview mirror. I'm sure oil prices will be a little bit lower at that point in time. And I think the year ends up in a much stronger spot than we are right now. It's pretty challenging right now. If I'm sitting here in 3 to 6 months, we'll be talking about a much, much different backdrop.
In 6 months' time, we'll play that clip again. That was Jim Zelter, the president of Apollo Global Management, with a much more constructive outlook on this moment, given the stress we're in right now. So let's take a picture, a snapshot of that stress. We're down across the board. Equity markets declining by 1.7% on the S&P 500. On the Nasdaq, we're down by 2 percentage points. In the bond market, bonds down, stocks down, yields up across the curve. 10-year yields this morning higher by 3 basis points at 435. Twos at 383. And check out crude, WTI and Brent. Now, just bear in mind, we're not comparing apples to apples here. The front month of the WTI futures curve at the moment is still May. On Brent, it is June. So if you were to compare June to June, WTI right now is trading about 98 on the June contract. So still something like a $10 spread here between the two. But the move we're seeing in crude, regardless, up by anywhere between 8 to 10% at the moment, near the front end of the futures curve. Off the back of the comments from the president overnight, this war's going to go on for 2 to 3 weeks, and anyone who works in this energy space right now will tell you things are stressed enough. Another 2 to 3 weeks, it can get a whole lot worse.
There are a couple of different issues. On one hand, you've got the physical shortages that are taking place in Asia, Southeast Asia in particular, but that also will be taking place should this go on through the summer in places like Europe. But there also is now a question of escalation in a region that accounts for 20% of the world's oil and gas supplies, could potentially cause further damage to some of the oil facilities, the natural gas facilities. That is a huge concern for a lot of people in markets.
That's the price action this morning. Let's get you some morning calls. First up, TD Cowen lowering its price target on United Airlines, noting investor skepticism due to, guess what, higher energy prices. That name is down by 5%. Your second call from KeyBank raising its target on Diamondback Energy, expecting global oil dislocations to continue into the summer. That name is up by 3%. And finally, Citi raising its target on Exxon, saying the conflict in the Middle East could create, quote, structural re-engagement in the sector. That name is up in the pre-market by 3%. That's some McKinsey speak where you don't really need it, right?
That's just amazing. Structural tailwinds to the industry that is currently
re-engagement.
structural
higher oil
re-engagement.
prices.
Okay. Let's stick with energy. President Trump vowing escalation in the war with Iran, sending crude prices surging.
We're going to hit them extremely hard over the next 2 to 3 weeks. We're going to bring them back to the Stone Ages where they belong. When this conflict is over, the Strait will open up naturally. It'll just open up naturally. That will resume the flowing and the gas prices will rapidly come back down.
Roukaya Ibrahim, Chief Commodity and Energy Strategist at BCA Research, writing the following. Emergency supply relief measures to ease tightness in global oil markets are insufficient. A large recovery in physical transit through Hormuz is still needed. Roukaya joins us now for more. Roukaya, welcome to the programme. Let's talk about the phase that we're in and might be entering. You know how this works. I've seen it in your research. Ultimately, when you have this kind of situation, you draw down inventories first, and then you start to worry about moving into a demand destruction phase. Are we entering that phase? Are we already in it?
Yeah, good morning. So I do think that the difference this time around is that in terms of demand destruction, there are really two factors. First of all, there's the higher prices, which will cause consumers to reduce their consumption. But also just the magnitude of the disruption and the shortages has already started causing some consumers to reduce their consumption, especially in Asia, where we see things like rationing, policy adjustments for shortened work weeks, working from home measures, things of that nature. So I think this time around, the demand destruction is likely to occur earlier because of that.
So, Roukaya, when the president says this could go on for 2 to 3 more weeks, where do you expect that demand destruction to show up next?
Right. I think what's happening now is we're seeing Asia at the epicenter of that demand destruction, but it is going to ripple across the global market, spread to Europe, as not only oil prices move higher, but the shortages also take time to impact European markets just because of differences in transportation delays.
When we see this start to move around the world, moving from Asia to Europe, what kind of price premium are we going to see when you start to see demand destruction increase?
Yeah, I think what's going to happen is we're going to continue to see global oil benchmarks move higher as long as transit through the Strait of Hormuz is disrupted. And I think the reason why oil prices are up today is because not only did President Trump not provide a clear sort of endpoint for when the Strait of Hormuz is going to be reopened, but the 2 to 3 week time frame also raises the possibility that energy infrastructure will be damaged during that period, which adds another layer to the disruption because it could potentially prolong the period that energy shortages are in place, even after the Strait of Hormuz is ultimately reopened.
How do you think about when the Strait of Hormuz, though, does ultimately become reopened? How long do you envision it to be going back to normal oil flows?
Yeah. I think that really depends, first of all, on whether energy infrastructure is disrupted. A couple of weeks ago, for example, we saw the Qatar energy facility being attacked. And, the news that we got from there is that it's going to take several weeks for, the production to normalize from that facility and reach full capacity. I think, first of all, it does depend on whether energy infrastructure is impacted, but also it does take several weeks for the production to come back online. According to our estimates, there's about 9 million barrels per day of crude production that has been throttled from the region. And that just can't be switched back on overnight immediately after the Strait of Hormuz is reopened. It's going to take weeks and potentially over a month for production capacity to reach its pre-crisis levels.
Roukaya, we're talking a lot about oil and natural gas, but it's also aluminum. There's about 9% of the world's supply comes through the Strait of Hormuz, and it really is related to Middle East production. We're talking about fertilizer. We're talking about a host of other materials. How much has that already been accepted in markets? How much has it already been priced in?
I think what we're seeing is that the first round effects are being priced in. We're seeing things that are immediately, directly impacted by the closure of the Strait of Hormuz go up. So, as you mentioned, oil, gas, fertilizer prices, urea prices, for example, have really shot up, but we haven't really seen the second round effects take place. And by that, I mean things like agricultural prices. They are a second round effect because higher fertilizer prices, higher natural gas prices also push up agricultural prices. So I think we're starting to see that happen. And the longer that the Strait of Hormuz closure remains closed, the more likely we're going to start to see these second round effects take place.
Do you think that right now, when you look at the futures curve, the forward-looking curve for commodities in particular, that the market has repriced sufficiently? I'm looking at WTI still sub $7 at the end of the year. I'm still looking at Brent crude in the 80s at a time when some people are wondering, exactly as Annmarie was asking, how long it's going to be until we get back to normal, whatever that looks like, as well as the stockpiling of resources that comes in the heels of a supply disruption.
Yeah, it's pretty remarkable that, the prices towards the end of this year and even more so further out in the futures curve haven't really increased that much. I mean, of course, they have increased, but the magnitude of the increase is really not that much. And I think, again, it really does depend on the duration of the closure of the Strait of Hormuz, because that, as this closure prolongs, it will lead to a more long-lasting disruption that will push up prices across the rest of the futures curve. But, ultimately, the futures curve is already extremely backwardated, and it will remain backwardated because what is happening is really a shortage that we're seeing right now. But as the disruption continues, we're going to see prices rise across the remainder of the curve until we eventually reach demand destruction levels that will then push down prices towards the end of the towards the back of end of the curve, as demand comes down sharply.
Roukaya, appreciate the breakdown. Thanks for joining the programme. Roukaya Ibrahim there of BCA Research. It's not just about the inability to pay the prices that crude demands right now, an energy product. It's the absence of the product right now. It's the actual shortages that Roukaya's talking about that have started in Asia and you might see elsewhere in a few weeks' time.
These are pandemic-era shortages in terms of just the inability to move around the way that you previously had, and potentially, when does that become codified in restrictions from governments saying don't use these certain supplies?
Just to give you a picture of the backwardation right now, we talked a lot about the 110 at the front end of the curve, of the futures curve for WTI, around 109.60 at the moment. Let's take December. I've always had one eye on the back end of the year. That's trading around 73. So when people talk about backwardation, if you're outside the oil market, just tuning in, interested in what's happening here, all that really means is the front end of the futures curve is way up here, and then way down here further out is where crude prices will be, potentially, in the future.
The expectation, it's going to go back down, way back down. And actually, that number has been going down over the past couple of trading sessions, so the normalization is widely expected.
Up next on the programme, more data, jobless claims just around the corner. The cash opens just around the corner, 60 minutes away. The price action shaping up as follows. Equities declining by 1.5%, down by 2 on the Nasdaq, following a really strong two-day rally on the S&P 500. The strongest, the biggest two-day rally we've seen going back to May of last year. In the bond market, yields look like this, going into jobless claims, seconds away. Yields higher by 3 basis points on 10s, up by 2 on 2s. With this move in crude, WTI briefly breaching 110. Brent crude advancing this morning. Brent higher by close to 8% at 108.90. Let's get you some economic data. With that data, Mike McKee has more. Hey, Mike.
John, well, it looks like the folks who are listed in the Challenger layoff announcements reports aren't being laid off yet. At least they're not filing for jobless benefits. Just 202,000 last week. That is down from 211,000 the week before. In terms of continuing claims, we see 1,841,000. That's up from 1,816,000 the week before. Basically, what we can say is there's just no change in the jobless claims numbers or the continuing claims numbers, basically, as the low-hire, low-fire economy continues. The other number out this morning, trade balance. negative $57.3 billion. That's up from, up, down. It's worse than the negative $54.7 billion that we had last month. These are February numbers. Imports rose by 4.3%. Exports rose by 4.2%, which is why it got a little worse. So even though the president's been on a trade kick, and this is the anniversary of Liberation Day, we're still seeing a fairly wide trade deficit based on imports of goods into the United States.
Mike McKee, stay close. Let's talk about that jobless claims number, 202. That is the right kind of downside surprise. The estimate was 212. So we've got a rolling 4-week moving average of around 208,000 on jobless claims, which is absolutely phenomenal. Put together with what we've seen in the data so far this week, retail sales okay, pretty strong. We saw the ADP number pretty decent as well. ISM, the headline number, we'll get to the details later, but the headline number was pretty good too. All of that building up going into payrolls Friday.
When you put this all together, all of these upside surprises, and you take a look at the U.S. Economic Surprise Index, it is now at the highest level going back to October of 2023. We have underestimated how much strength collectively as analysts across Wall Street, underestimated how much strength was in the U.S. economy, both in the labor front as well as in the manufacturing and other sectors fronts. How much does this buffer the U.S. economy from any kind of growth shock, and how much does it just sort of feed into the ability to absorb price increases and pass it along in the form of inflation?
Mike McKee still with us. Mike, let's talk about that. To Lisa's point, how much momentum did we have coming into this month and moving into April?
We did have some decent momentum. When you look at the sales numbers, American consumers still out there, even though we have seen some decline in consumers' confidence. The question is, do they continue? Most of the data we have now is before the war started. We didn't get the latest retail sales numbers for March yet. So let's see how people hang in there and how spending patterns might change given the cost of gasoline. Labor market hasn't changed in months now. Basically, companies aren't hiring, but they're not firing either. Everybody waiting to see what's happening with tariffs and now with the war.
Mike, does this give the Federal Reserve more space to worry about the other side of the mandate?
It does. They have basically said they're more worried about inflation than they are about jobs right now, because inflation they know is going to rise because headline inflation will go up with oil prices. But does it get into other parts of the economy? And what is the continued lagged effect of tariffs? That's what they are worried about, and they're not going to know for a while. I made the argument that it's a little bit easier, maybe, job for Kevin Warsh if he joins the Fed on time, because now he can tell the president, with inflation above 4%, and predictions are we're going to get there based on oil prices, I can't justify arguing for lower rates. Instead of having to say the economy is strong and we don't need to lower rates, he can say, well, inflation's too high. So maybe he stays out of the president's crosshairs for a couple of months.
Yeah, good luck, Mike. Thanks for that. Appreciate it. Mike McKee, thank you very much. Wishful thinking there. I'd love to know how that conversation would go.
Listen, Mr. President, it's look at the inflation levels, and Mr. President's going to say, absolutely not. We want those rates lowered. We already are hearing it right now.
Looking ahead to payrolls Friday, let's get to the data. The estimate, 65K. That's the median in our survey. Talked about this very wide range. At the high end, we're looking for 151. That's the high estimate in our survey. The low is negative 16,000. The number drops 8:30 tomorrow morning. We'll be here in the studio right here at Bloomberg Surveillance, live from 7 a.m. Eastern Time all the way through to 10 o'clock. Let's give you an update with Alejandra Grindal of Ned Davis Research on what she's seeing in the data. Alejandra, welcome to the program. The data so far this week, pretty strong. How much momentum's in this economy?
Yeah, so really, thanks for having me again. So yeah, really strong data. The jobless claims do reflect the post-war environment, but as Mike McKee mentioned earlier, a lot of the data has also been pre-war. But, ultimately the bottom line is we went into this crisis and, maybe not a booming position, but at least far from recession territory. And typically we've found is that when you have policy uncertainty, when you have wars, the economy tends to be slightly more resilient if it's starting from a good starting point. In other words, we tend to shrug it off. That being said, I don't think we'll come out of this unscathed. Affordability isn't necessarily great. Long-term yields have risen, so it's a little harder to buy a home, obviously. And maybe the Fed will delay the potential rate cuts that we were expecting. So we do see downside risk from this crisis, but we don't anticipate it putting the U.S. economy into recession.
Well, let's just stand the momentum we've got for now and think about what it might mean for the Federal Reserve in the future. We've been told repeatedly over the past 5 weeks or so that there is low potential for second-order inflationary effects because, quite simply, this economy is not strong enough and the labour market's not tight enough. Does the data validate that consensus view?
So, I think a lot of people have drawn parallels to, say, 2022. Right, where you had that oil price shock. And if you compare, so I did mention U.S. not headed for a recession, but if you compare now versus back in 2022, where you did see those larger second round effects, and it's obviously freaked out a lot of central banks around the world, things were different then. I mean, the starting point in inflation was much higher, demand was much stronger, and it was almost like you had this supply shock already jump on something that was already headed toward, central banks that were already headed toward excessive tightening. So I think right now, yes, things aren't by any means horrible, but the outlook is a little more balanced. Of course, it has to do also with how long the war lasts, right? I mean, that's what everybody's saying, and none of us actually know. So anytime you have these higher energy prices, and if they stay for a long period of time, say 6 months to a year, which, as you talked about earlier, with the backwardation of the oil curve, a lot of people don't anticipate that, but assuming that does happen, then that will get into our heads, create second round effects, and then lead to a long-term spike and long-term inflation expectations. And that's really what I think the Fed's going to be looking at.
It's a complicated backdrop for the Fed.
Yes.
It's an even more complicated backdrop for the European Central Bank. I just wonder whether the inflationary pressure is going to be similar overseas or whether it's actually going to be more, I don't want to use the transitory word, but more transitory, more temporary in nature because of the growth shock aspect that might be dampened by the robust growth in the U.S.
Yeah, so definitely we have found that it's not an apples and oranges comparison between the U.S. and Europe. Europe does tend to feel the inflationary impact and the second round impact of energy prices to a greater degree than the U.S. does. I mean, we saw that. But again, 2022 is very different from today. In the case of Europe, you don't have that same strong demand, stronger labor markets, that higher starting point on inflation. So there are some parallels from that respect. But yes, they tend to see the stronger second round effects. And you also have to keep in mind the Fed has a dual mandate, employment as well as inflation, whereas the ECB just has the one mandate of inflation, and they target the headline as opposed to the Fed targeting the core. So they are in a slightly, I would say different position. It is possible that the Fed, that the ECB will move to easing policy this year, tightening policy. I have to get that right. They might move to tightening policy this year. And that wasn't our base case. But I think, last I checked, the market was anticipating 2-3 rate hikes by the ECB. And given just the downside risks that the oil price shock does present to European growth, we don't quite anticipate that much tightening. Maybe one hike to sort of, show that they mean business, right? But it's kind of stay in wait and see mode after that.
What are you going to do with tomorrow's jobs report, given the fact that it feels a little bit like doing the crossword puzzle at the back of a newspaper after reading the headlines?
Yeah, it'll be just the many of pieces of data that we put in together to come up with our final outlook. We don't like to hang our hat on one indicator, that sometimes, the data is prone to quite a bit of revision too, but it's still a key report, and it does represent that March environment. And as I mentioned before, we don't have a huge amount of data reflecting March. It's a lot of soft data at this point. So this will be some hard data reflecting that number. And to your point, there's a pretty wide range of expectations. Our view is we're a little bit below the consensus of about 50,000, a little bit of payback from, the healthcare strikes that we had in February, as well as the poor weather that we had in February. If the number goes significantly above or significantly below, there could be an adverse market reaction either way, because if it goes really low, there's a view that the economy is not as strong as we think. If it goes above, it could be viewed as inflationary. So we're hoping for that Goldilocks sort of, 50,000 scenario. Who'd have thought 50,000 would be Goldilocks? But I think in these days it is. Yeah.
I know your base case is still for no recession, but a lot of guests have come on the program and actually upped the probability, though, by the end of the year, higher than they thought at the start of the year. What would it take for you to potentially relook at that potential outcome?
Oh, yeah. I mean, and if you were to ask me now versus 2 months ago, definitely see a higher risk of recession. But it's still a low risk, if that makes any sense. It would really have to do with the longevity of the war, right? How long do oil prices stay elevated? How do they start having second round effects? Does the Fed, do long run inflation expectations get impacted? Good news so far, they haven't been. And does that have to move the Fed toward more aggressive tightening? Again, maybe not recession end of year, but it could put that into next year.
Alejandra, appreciate your time responding to that data. Thank you. Alejandra Grindal there of Ned Davis Research, following better than expected economic data in America. Another one, downside surprise on jobless claim. As we always say, the right kind of downside surprise. Check out this news from Blue Owl. Stock is down in the pre-market by something like 8%. Just bear in mind, this name at the end of last year was trading around 15. It now trades around 8. It's been cut in half almost. The stock is down by more than 8%. These headlines from the Bloomberg team just moments ago. 2 private credit funds capping redemptions at 5%. Go through the redemption requests individually. For each fund, investors in the $36 billion Blue Owl Credit Income Fund, one of the industry's largest, asked to pull 21.9% of shares in the 3 months ending March 31, according to an investor letter. As for the other fund, the Blue Owl Technology Income Fund, saw shareholders asking for 40.7% back, compared with 15.4% just 3 months earlier.
And Blue Owl is going to respond to these redemption requests by limiting it to that 5% cap that some of its other industry peers have been doing, in contrast to earlier allowing a greater proportion to be redeemed. The scope of requests for redemptions highlights how Blue Owl really has become sort of the epicenter of a lot of the concerns, given the fact that they invested heavily in the data centers, as well as other technology and in software sectors that some other people said were a bit riskier. A question here about whether this is a specific issue to a couple of different loans or whether this is an industry-wide issue. Jim Zelter was on moments ago talking about how he sees this as, what was it, noise?
Take a walk.
Take a walk.
Noise for the broader asset class.
Correct.
I think is the frustration coming from some of these private credit managers right now.
Because there are people who have behaved in a more disciplined or less risk-on kind of way. That said, there's clearly is an issue that some people continue to harp on, and you can see that in the redemption requests.
And the clue might be in the name, Blue Owl Technology Income Fund. And that's why the redemption's there. The number is so much larger, I would imagine. The issue I've got with this brand, we've talked about this a few times over the last month or so. The problem you've got now, knowing they're going to cap redemptions at 5%, that is basically the industry standard. And as Jim said, it was there in black and white ahead of time anyway, that if you want your money back, you're going to put in a much bigger redemption request. So it'd be interesting to me what the source of the redemptions are, how isolated they are in a handful of investors who are thinking that way and putting in a bigger number to redeem.
Does 40.7% of this Blue Owl Technology Income Corp represent 40% of total investors, or two investors that are putting in significant amounts asking for redemptions? There's also a question at what point some of these funds actually have to start to sell, because what you have seen is that inflows to some of these funds, not Blue Owl, but more broadly in the industry, have been matching roughly what the outflows have been. So you don't have to have the fire sales. At what point do you actually see that pressure valuations of the underlying assets?
Blue Owl down by 8 to 9% so far this morning in the pre-market. Let's get you an update on that and stories elsewhere with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. Applications for U.S. unemployment benefits fell last week, suggesting layoffs remain low. Initial claims decreased to 202,000 for the final week of March, shy of what Bloomberg economists were anticipating. These numbers coming ahead of the March payrolls report, set to be released tomorrow at 8:30 a.m. Eastern. We will see you here. Blue Owl is limiting redemptions at 5% for two of its private credit funds following a massive surge in withdrawal requests. Investor letters revealing shareholders tried to pull 22% of shares from its credit income fund and 41% of shares from its technology income fund. The firm saying the caps are necessary to balance the interests of all shareholders. And the headquarters of Goldman Sachs in Paris was placed under police surveillance last night following bomb threats believed to be from an Iranian group. The threats come just days after a bombing attempt was foiled near the office of Bank of America in the French capital. Citi telling its Paris and Frankfurt employees to work remotely as a precaution. That's your Bloomberg brief, John.
Yahara, thank you. Thank you for the update. Up next on the program, Ohsung Kwon of Wells Fargo warning prolonged war limits potential upside. Plus, Danny's going to be back. She's got your morning movers. Blue Owl capping redemptions from 2 private credit funds. That name down by 9% in the pre-market.
There is so much uncertainty. What the market is not paying enough attention is the persistence of the shock, even if the war ends in 3 or 4 weeks. It's not just about the war is over, it's about normalizing the flows in the Strait. Lower growth, higher inflation. The question is, how much lower, how much higher?
That was Claudio Irigoyen there of Bank of America on the outlook for inflation, for growth, for the global economy and what central banks might do or might not do in the future. The scores this morning look like this as we count you down to the opening bell. Equity futures near session lows. We're down by 1.4% on the S&P. On the Nasdaq, we're down by 1.8%. With some morning movers, some single names. Danny Berger has more. Hey, Danny.
Hey, John. It's shaping up to be an especially painful session for Blue Owl. Stunning redemption requests for 2 of their BDCs. You were talking about it before the break. One of their tech-focused ones, 41%. The other one, 22%. They are gating the funds, only allowing 5% to come out, as is the standard for their prospectus. Blue Owl does point out that 90% of investors said that they're sticking with the fund, so that 10%, it was really concentrated of the outflows. But again, these numbers are stunning. Some of the bigger numbers we've heard, Oaktree, for example, 8.5% was their redemption request, which, by the way, Matt and I will be speaking to the co-CEO in about 2 hours' time of Oaktree. But still, these are big numbers. It has the market worried. Blue Owl down almost another 10%. It's already lost 65%, this stock, since its peak. Elsewhere, we're looking at the impact of higher oil prices and generally negative risk sentiment this morning. WTI up as much as 12%. Chevron, Exxon, Occidental Petroleum, all the oil majors undo some of their losses over the past 2 days and post up gains as high as nearly 4%. In the case of Oxy. The flip side of this are those that will have to pay for higher energy costs, and the airlines continue to be the poster children for this. The American-based carriers down at least 4% this morning. In the case of Delta and United, that's 4.33%. Of course, the woes even more acute for international, European, and Asian airlines, looking at higher ticket prices, but still the pain clearly expressing itself this morning, John.
Hey, Danny, thank you. Thank you very much. Danny's going to guide you through to the opening bell in about 10 minutes' time alongside Matt Miller, so look out for that. The pain for the airlines. Think about the month they were having before this war started, the guidance they were offering, really strong numbers they'd seen in the underlying business, and then this, bang, different story. 20 to 30% of their total costs suddenly increased by more than 50% with jet fuel now in short supply in places like Europe. How do they pass this along to consumers? Will they tolerate higher prices? That is what we're going to be looking for in the earnings season. Things have changed for the team over at Wells Fargo. Ohsung Kwon cutting his year-end price target on the S&P to 7,300 from 7,800, writing this: other than a firm resolution, we don't see many upside catalysts and see the setup skewed more negatively for equities. Ohsung joins us now for more. Ohsung, good morning.
Thanks for having me.
Obviously weren't expecting the war. Not many people were. Things have changed. But typically you see Wall Street wait. Not married to their forecast, but want to really understand what they're confronting. You've moved fairly quickly. You've waited a month or so. What's changed for you permanently for the year ahead?
Yeah, I mean, I think the biggest risk is inflation. I mean, that's something that we have been highlighting even before Iran war, that potential inflation reacceleration in the second half of the year is the biggest risk to the equity market. And now that the Iran war happened, I think that risk has gone up. At the end of the day, inflation is really too much money chasing after too few goods. Money supply has turned. Inventory levels are low. We are firmly in a restocking cycle, which typically drives inflation. So that underlying backdrop, plus what we're seeing in commodities, I think that sets up pretty negatively for second half inflation.
We live in a nominal world, and there are instances where that can be good for stocks. Why is this bad for stocks? Margin risk, what is it?
Yeah, no, I'm not saying this is, absolute negative for stocks. And I think it ultimately depends on what the Fed does. If the Fed is okay with 3%, then I think equities are going to work. And there's a good chance that they are going to be okay with it, because I think both Washington and the Fed want to inflate out of this deficit issues through inflation, basically. So if they're okay with 3%, and look at what's happening in Japan. And I mean, that's the perfect example of the debasement cycle, which is basically translating into rates ripping, FX collapsing, and stocks are going higher, actually. So, if something like that happens in the U.S., then I think equities are still going to work, at least in dollar terms. Maybe not in gold, but in dollar terms.
At what point At what levels do yields become a constraining factor on the multiples on equities? And I'm not just talking about the front end, which is more controlled by central banks, but more 10-year denominations and the borrowing cost there.
Yeah, I think it depends on what's driving rates higher. If rates are being driven by higher inflation and a hawkish Fed, then that's negative for multiples. If it's being driven by a good economy, then I don't necessarily think that's bearish for equities because earnings are going to be offsetting that impact.
Do you think that there's going to be the same leadership in this construct as there was before the Iran war?
So, heading into this year, we were getting more bullish on cyclicals, commodities. Commodities was our top sectors heading into this year. Yeah, thank you. We were more cautious on tech, but with this event, I mean, what this did was it at least put a dent on the growth outlook that people were getting really bullish into. And the biggest driver of that bullish outlook was A, the restocking cycle, which I think is going to continue, but also B, the one big beautiful bill, the tax return, which is going to get wiped out basically. The thing is, I think the economy is going to be okay because the cost of living that's spread out over the next 12 months. Whereas one big beautiful bill, that's happening today. People are collecting their tax returns today. So that's going to be a cushion over the next 6 months at least. So I think the economy is going to be okay. But at the end of the day, this is a K-shaped widener because the bottom 40%, they lose right away because they weren't getting that much from the tax return anyway. Whereas the top 20%, even over the next 12 months, they are still going to benefit by about $1,500. So I think this is a K-shaped widener.
Ohsung, it's good to see you. Thanks for the update. We appreciate it. It's a moving target, I know, and things are moving pretty quickly. Ohsung Kwon there of Wells Fargo. We're getting closer and closer to a long weekend, and you just wonder where we'll be when we come out the other side.
Long weekend? What are you talking about? It's not going to be a long weekend for us. We're going to be here tomorrow, but that's the reason why how many people are trying to de-risk ahead of what is a long weekend for most people.
I like what Ohsung said there. This one big beautiful bill, all of that money, that tax refund, the president talked about last night, how much of that is just going to your local gas station for most consumers?
3 days for the president where the market will be largely closed. Troop build-up continues to build. Back and forth in terms of the communication and the verbal intervention we've seen so far. That's what I'm trying to figure out what the next few days looks like in this conflict.
Yeah, and how much people are trying to de-risk ahead of that, because we just got a warning shot saying escalate to de-escalate, and people are taking that seriously.
To Abramov's point, we will be here tomorrow morning, 7 a.m. Eastern Time. Not quite an early start, an early-ish start. Going into this, the payrolls report at 8:30 Eastern Time. We'll catch up with Priya Misra of JP Morgan, Francis Donald of RBC, Torsten Slok of Apollo, and the National Economic Council Director, Kevin Hassett. From New York City this morning, good morning to you all. This was Bloomberg Surveillance.